record it here. Admit. All right, guys. I know I'm really prompt on time, so I'm going to go ahead and kick things off right now. Still adding people that are coming into the meeting. Let me go ahead and fire this up, and then let me come back over and share the screen. Make sure that was working. Okay. Share screen. You're going to share this. And hopefully everybody can see this screen okay.
Yep.
Awesome. John, I may ask a favor of you. Let me go back here for a second. I may ask a favor of you. I'm going to make you a co-host. If you can help me admit people in, that'd be great. You'll just see. There we go. Cool. So I just made you a co-host. You'll see people maybe popping into the waiting room. If you don't mind keeping an eye on that for me, that'd be fantastic. But
on it.
You rock. So like Gregism just wanted to come in. We'll let you admit him. Yep. Perfect.
Yep. Good deal.
Awesome. Thanks, John. I appreciate it, man. Makes my life a little bit easier. All right, guys. Hey, welcome everybody to tonight's training on options. Guys, my name is Gary Stern, and I go by G Dinero, as a lot of you know me. And this came about because I'm part of an investment community called IA, Invest Answers. And we're a community of like-minded individuals that are interested in investing, interested in securing our financial futures, interested in beating the big guys at their own game, so to speak. And as a part of that group, a lot of people were struggling with some of the things like the technical analysis, how these charts work, as well as options, where to start, how to do options. So I figured, what better way than to get us all together and to do, at first, it'll be a presentation for the first few minutes, and then we'll open it up to everybody. It may run a little longer than advertised. I hope you guys are cool with that, and I know you'll find value in it. So before I jump in, again, my name's Gary. I'm based out of Melbourne. That's not Melbourne. Those are my friends down under that it's like tomorrow morning. But Melbourne, Florida. Florida's on the East Coast. Last night, watched another Starlink rocket go up, a Falcon 9 rocket, throwing Starlink satellites up in orbit. So it's pretty cool to have that in your own backyard. And especially for a lot of us, we're big Elon Musk fans, big Tesla fans. So it was pretty cool to see that. And then it goes up, and 8 minutes later, the booster lands back on a barge in the middle of the Atlantic. So anybody that thinks that that stuff is just spectacular, I mean, it's amazing. You should see it firsthand. Second thing I want to say is I kind of took this disclaimer from a friend of mine. I'm not providing financial, investment, tax, legal advice. I'm not going to read this whole thing, but the bottom line is, guys, I'm sharing a few strategies around technical analysis and basically the how to execute an options trade. Like, what is an options trade? What are the different types available and how to execute it? I'm not telling you to go make a specific trade on a specific asset. I may show you a couple of examples of ones that I've done. I may show you some examples of charts where I've put the indicators on there and how I read those indicators and what they're useful for. These are all my opinions, and I just want you guys to know that I'm not a registered legal provider of investment advice. So again, the impetus for this comes from my buddy James, who runs Invest Answers. John, my best friend who's on this call with us, he introduced me to James, probably 3 years ago now, and said, there's this guy that has a pretty even keel. He has a funny accent. He has a pretty even keel when it comes to presenting on YouTube. And he's not hyping up the latest crypto project, just like he's not turning around and sandbagging the heck out of stuff. He's just throwing numbers out. It's very data-driven, very mellow delivery. Unlike mine, I get kind of excited, but a very mellow delivery. You should check him out. And what I realized over time was James compliments me from a from a number standpoint, we both have that analytical drive, but James can remain calm. And that was something that I struggled with, was getting my emotions in check. Maybe you're the same way, where you struggle with getting your emotions in check. And what I've learned is to trust the data at the end of the day. So just have to throw a huge thank you out there to James. I put down there where his YouTube channel is. You'll see that right here. His Twitter handle, make sure it's the invest_answers, the one with the blue check mark. He probably has 200 or 300 imposters at any given time. Same with some of his other, any other, he's not on any of the other social medias, but just make sure you're following the real Invest Answers. On YouTube, he has over 440,000 subscribers. That's the guy you want to follow. And then this is James's website. It's investanswers.io. That's where some of these products are going to be that I'll be talking about tonight, if you're not already a member of the community. That's also where you can join Patreon and follow him on a regular basis. So got all that out of the way. James, again, thank you, buddy, if you're watching this. So what is technical analysis? So you've seen James probably throw this slide up there. First off, we have to understand there's really two types of analysis, two main types that you're doing when you're looking at an investment. The first one is fundamental analysis. That's revenue, earnings, growth. That's like today. Tesla announced their third quarter earnings, right? And they talked about what was their revenue, what was their earnings per share, what was their EBITDA. All those things talk about where the company is now, where they're projecting it to go in the future from a fundamental analysis, right? Based on the number of shares outstanding, based on the number of deliveries in the case of Tesla, the production numbers, things along those lines. That tells you what to buy, going and finding a company that has a future, so to speak, right? But the when is where the TA comes into the equation. And TA is technical analysis. That's looking at market data, price, and volume to predict future behavior. So basically, that's the when to invest, trying to look at tops and bottoms. I'm not telling you to try to 100% time the market, because it's not timing the market, it's time in the market that matters, because you could miss some of those huge days. I'm going to teach you how to be in the market at any given time, but to maybe be sliding from one asset into another that's a faster moving horse, as again, our friend James likes to say. So what are my favorite technical indicators? Some of these you may never have heard of, and some of these you're going to know inside and out. The first 7 or 8 on the list, price and volume, that's pretty obvious. Those are technical indicators. Fibonacci retracement, that's a tool that's readily available in TradingView. We will be talking about TradingView today. Support and resistance levels, right? Where does the stock run out of steam, or the asset, the crypto or the option? Where does it run out of steam? That's resistance. And where does it find support? Where does it turn and flip that trend and go back up again? We'll talk about channels. Some people don't think that these are super reliable. I've had a lot of success over many years of looking at things in channels. They tend to stay in a channel. When it breaks down or up, that's a signal to you that you need to be looking elsewhere, or maybe looking to make a trade. SVP, VRVP, session volume profile, and I just blanked on what VRVP is, but that looks at the different prices at the levels that all the shares have traded at over a given period of time. MAs, those are moving averages. The most common are 50, 100, 200. You'll have people look at a 20 or 25 moving average. You might even have people looking at shorter term moving averages, looking at a 3 over a 7 or a 7 over a 21. I mean, there's a lot of different factors out there. I just want to give you an idea of what the moving averages are. And then we'll talk about the IADSS suite. That's the Invest Answers Decision Support System. So again, those are the indicators that James and his team came up with that pull data from numerous sources. So they're like having a plethora of indicators in one. So we have the confluence, mean reversion trend. That's the general IADSS. We have the optimized trend. We have LILO, which is the layer in, layer out model, looking at where to get in and get out, different price levels. MicroStrategy Arb Cloud, arbing between MicroStrategy and Bitcoin. the pair trading on steroids, PTOS, and last but not least, the DCAS, which is dollar cost averaging on steroids. Many of you may know what dollar cost averaging is. We'll talk about that as we get there. So price and volume, I skipped those. Those should be pretty obvious to you. So what I did was I took a chart, and it's going to be the same chart, but I deconstructed and pulled everything out of it that I'm not talking about necessarily. So all I'm going to be focused on here is this rainbow looking chart that starts here from 1 and goes down to 0. And that's called a Fibonacci retracement. What is Fibonacci retracement? Well, the world works on kind of a Fibonacci sequence. If you look at a Nautilus shell, it grows in a Fibonacci sequence. If you look at how the Romans and the Greeks built the architecture back in the days, they did it following a Fibonacci sequence. It's just nature. It's the way that nature aligns itself. And what's crazy is that we as humans follow that same rhythm of nature with very, very predictable results. So how do you set? And again, if you want to know more, like really dig deep into these things, just remember fib retracement, go look it up and dig deeper into each of these. I'm giving an overview of each. We could talk for an hour just about this. So I'm giving you overviews. Why is this one of my favorites? Well, take Tesla, for instance, back in November of 21. That's when it hit its all-time high. After the split, the adjusted price would have been $415, right? $414.50. So you take and you basically put a dot right here. You drag that down and you put another dot down here, and that's how you set your fib retracement levels. It was the all-time high or the most recent high and the most recent low. Now, I know a lot of you will say, well, it hit a low here, it hit a low here, it hit a low here. What I'm talking about is after a reversal in trend. So it was going up until this point, and then it kept going down. It hit a lower high, hit a lower high, hit a lower high, hit a lower high, lower high, finally bottomed out. And then this high right here was higher than this one. So that's how I knew to set it from this point down to this point. You'll also note, some of you that are familiar with Fibonacci retracements, you may use a shorter time period. I use long time periods because look at the predictability of the various levels. These are basically looking at how far did it retrace. In this case, this is the 78.6% level. So it had already retraced about 22%. Then it pulls back here to the 61.8% level, here to the 50%, down here to the 38, down here to the 23, and down here to the 0. Don't worry so much about the exact numbers. Just realize, look at how it comes and pings off of this line, comes back and sits on it, breaks it, hits this line, comes in back, spends a little time here, comes back up, spends some time here. Whoops. Back down here to the line, spends time there, drops down to this one, spends some time there. It's support and resistance levels. Think of it as support and resistance levels. How do you use it? These might be places where you might have sold here and you might buy back in a portion here if it uses this as support. Where it hit here as support, maybe that's a layer back in level and you take profits up at the next level up. So you can think of these as support and resistance levels with Fibonacci retracement. I said we'd talk about VRVP and support and resistance. Here's the VRVP. That's the name of the indicator down here on the right-hand side. And you'll note that the red line is where the most number of shares have traded hands over the prescribed time period. I was trying to keep it right around the same time period, going back to where that high was with Tesla. In fact, I went back 1 year too many because it would have been right here was where the high was. But basically, this will tell you on the way up and then back down to this price of 100, where were the majority of shares traded? Well, right here at 200. And then the next most number, we're at 225. So basically, you know that as it comes down to there, that will act as support. Look at how many times 200 acted first as resistance right here, trying to break through. Then right here, support, 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 shoots up, comes back down, boom, support, shoots back up, back down, boom, support, breaks that level of 200 where the vast majority of shares have traded. Now it's acting as resistance when we're below it. When we're below it. Had resistance again on the way up, resistance again on the way up, broke right through it with flying colors here in about June of this year and hasn't looked back. So if somebody were to ask me, how far do you think Tesla could fall? I don't have tea leaves. I'm not a predictor. I am not giving you financial advice, but I'm following the numbers here. And this would tell me that there would be strong support at around 225 and then super strong support at 200 because so many shares have already exchanged hands there that people are going to protect their positions. Like if they bought at 200 and it shot up and for whatever reason they didn't get out, they may sell at 200 in order to protect their position. Whereas somebody else who knows that that's where the cost basis of so many other people, they're going to buy in. They're like, if I can get it at 200, I'm golden. So that's how that would be utilized. The one that I realized I didn't put on here is I don't know where it went. SVP. It may be coming up later. If not, I'll talk about what that is. Channels. Here's an examples of channels. Here's an example, for instance, going down of just a line, right? That's like a resistance line going down that we hit up against on a number of occasions. I could have turned it into a channel by just dragging and putting another line parallel to it. And you would have seen it would have been pinging back and forth in this channel. But I wanted to show like one example of a trend line that once we broke it here, notice we broke it, the light blue line, we broke it with the price, whoops. And then as we came back down, notice right here, we retested the light blue line and it acted as support. It was resistance for the last 2 to 2.5 years. Then we broke it and now it's acting as support, okay? Channel, same thing, same rule applies. You'll note that we hit these highs right here. And so then I just drew a line from there across, actually from this high across through those two right there, and just continued that line outwards. And with predictability, we're trading right here within this trend. And you'll see that when we go to a live chart today, you'll see we came to the end of this pennant, and based on today's earnings, we kind of broke down through that pennant there at the end a little bit. So that's how you can utilize channels to predict how an asset will trade within a range. And sometimes those are uptrending, sometimes they're downtrending, sometimes they're just straight across. You're going between, maybe in the case of Tesla, 250 and 200, and you're just pinging back and forth between those. It doesn't tend to go sideways much. It tends to either go trending up or down, but you will see that with different assets. Again, looking at the Tesla chart, here's the 50 SMA. If you're looking for an indicator where it shows you these little blue tags and blue, red, and yellow tags, I made those. I drew those on here so that you would know which color was which. They don't show up like that. But in this case, the blue is the 50-day simple moving average, the 100-day simple moving average, the 200. That tells you where the stock has been trading on a daily basis over the last, in this case, I'm going back to November of 2021. And it shows you that here it's trending above all three moving averages. That means that stock is red hot. When the 50 is above the 100, above the 200, it means that in the short run, Tesla has spent more time above the averages, more time above where it has over the last 200 days, 100 days, and 50 days. That stock is red hot. Notice that we actually use the 50 right here a little bit as support. We use the 100-day simple moving average as support. We got back up here to the 50 and hovered around it, then dropped down to the 100, broke that, and dropped all the way down to the 200. Now the 200 is acting as resistance. So this is another tool you can use. You can put all this together as you're formulating when to get in or get out of an asset. You'll notice that this is very top heavy, and look how far away from the 50 we are. Whereas this was a low, here's a rock bottom low, right? $100 or just a little over 100. I think it was 103 to be exact for Tesla. Look how far below the 50, the 100, and the 200 we are. That is a stock that is severely undervalued when compared to its historical average. And you'll notice that this 200 acts as support and resistance more so than any other price level on here. Support up to here. Now it's been resistance when we're below it. We go back above it. Now it'll act as support again. Now the 100 is starting to act as support. Pretty soon the 50 will be acting as support. Last thing I'll say about this, when the 50, the blue line right here, crosses below the 200 like it did right there, that's what's called a death cross. A death cross. That's where your short-term moving average crosses below the longer-term moving average. That's telling you you're kind of going into a bear market with that asset on average. Predictability or probability of it, I think, is somewhere in the 60 to 70% range. I've heard James and other, super intense analysts talk about. On the converse, right here, down here in almost July, like late June, early July, you'll note that the 50 and the 100 both crossed through the yellow line, the 200. So the blue crossed through the yellow to the upside. When it crossed through it to the downside over here, that's a death cross. When it crosses through it to the upside over here, that is a golden cross. I did put SVP in. All right. SVP, Session Volume Profiler. So what that is let's look at, so this chart is a 15-minute chart. Most of what we've been looking at up to this point was either a daily or a 4-hour. This is useful, especially on the intraday charts, meaning when you're down at 15 minutes, 10 minutes, 5 minutes. And let's just look at this block right here. So from the 9th to the 10th of whatever this was, probably October, because I just put these slides together. What you'll see here is over the course of this 24-hour period, and it's not quite 24 hours because I have on extended trading hours, which is this light orange color and the light blue background color, and then the darker color is the normal session, the 9:30 a.m. to 4 p.m. Eastern time. But this is an entire trading session right here, from this vertical line to that vertical line. And you'll note that over the course of this trading session, the vast majority of shares traded right here at about the 255.50 level, 255.50. That's where the most volume took place. We had a little bit of volume take place up here. We had even more take place below it. What the red line is where the majority took place. How would you use this? Well, you would use this if you were looking to make a buy. You don't want to buy when you're above this red line. You want to buy when you're below it. And conversely, if you were looking to make a sell, you would want to sell when you're above it, because that way you're buying below what the majority of people have bought at, and you're selling above what the majority of people have sold at. That's how you would use this session volume profile. Just tells you where the vast majority of the volume took place during that trading session. Now we're going to jump into some of the more proprietary levels. Unlike James, I don't drink coffee at this time. I'd never be able to go to sleep, but water, sponsored by water. IADSS. So Invest Answers Decision Support System. Conf stands for confluence. MR is mean reversion. Trend is trend. So what do we see on this graph? Well, what we see on this graph is a number of things. I'm going to start first with confluence. Do you see this little sell flag up here? And the buy flag, the green buy flag right there. There's another red sell flag. Here's a green buy, green buy, green buy, green buy. You see some faint green and red triangles. If they're faint, those are not signals. Those are signals that didn't close. It was about to throw a signal, but there wasn't enough data for it to throw it out there. Only the ones that have the words buy or sell and the dark red or green, those are the ones that we're focused on. That's confluence, along with this cloud that you see in the background. The cloud kind of works like Bollinger Bands, if you're familiar with them. I didn't talk about those on here simply because I think this indicator blows away just using Bollinger Bands by itself. But how would you read this? Well, right here, you'll note that on the left-hand side of the graph, or even let's use this because it's kind of more towards the center of the graph. Notice that the stock price is trending right along the upper bands of this confluence cloud. It even goes out of the cloud. And when it goes out of the cloud significantly, you'll get this sell signal. That's telling you that the stock is running hot, right? It's a little bit overbought. It may be time to look at selling off a few of your shares, especially when you get a sell flag. And you can check that with a back testing down here. I'm not going to go over how to set all that right now. We can talk about that after the fact, but you can back test this. You'll note that if you follow just these confluence sell and buy flags, the way that I have it set up, you'd have 100% success here on the 4-hour chart, 100% success. Okay. That's the confluence. Also, conversely, let's look at this buy signal down here. You'll notice that the price is trending along the bottom of the cloud, and you get a buy signal when it's outside of the cloud, and all of a sudden all the other factors align. It started to throw a buy and then threw one right here. The second thing you can look at is mean reversion. That's in this lower pane down here at the bottom of the screen. And what the mean reversion is these are red and green dots. Think about it. Everything reverts back to the mean, meaning this is the fair price, let's say, of an asset. This is the price that it should theoretically be valued at, theoretically, right? And in some cases, the price gets bid up, and then it reverts back to the mean. And then in other cases, it goes down, and then it reverts back up to the mean. That's what mean reversion is. And the numbers you see are the number of standard deviations away from the norm. So if the stock normally trades here and it's up one standard deviation, that's telling you it's getting hot. You might be looking at taking some profit soon. Conversely, if it's normally here and it's trading down here, you might be telling yourself it's time to start selling or start buying back in some of these shares. It's oversold. It's time to go ahead and start jumping in and buying some of these shares back, okay? That's how mean reversion helps. Notice how the mean reversion is working in tandem with what you saw with the price and these sell flags. When it's a red dot, like these got cut off. I'm sorry, I didn't have it on automatic, but there was a red dot above these other ones. So there's 1, 2, 3 here right along this red line. And then there's another red dot up in here that you wouldn't be able to see. That corresponds with a red sell flag. That's now with conviction, because that's a 92% win rate on this mean reversion. That's telling you it's looking like it's time to sell. This is telling you that it's time to sell. And the third of the big three amigos, as I call them, is the trend. And it's the last one typically to flip. And it's hard to see in here because I have my trend set to tight. We can look at it on a live chart later if you guys want. But what you'll see here is, notice that it's blue, the background. There's blue, blue, blue. And no, you can't make this up. James, the colors he chose for this were blue and orange. My son goes to the University of Florida. Their colors are blue and orange. I'm a Gator. Their colors are blue and orange. So James, you didn't even know that when you were setting it up, but thank you. I know one of the guys on here, Arsenal 1, he wants to change the colors to red and white. I'm with you on that one too, mate. In fact, the colors stand out even better on red and white. But regardless, this blue means you're in an uptrend. So from this buy signal, the trend flipped blue. This is where you enter the trade. We had gotten a green mean reversion dot at the bottom. We have a green buy signal here. The trend had been orange and it flipped to blue right here. I don't know if you can see it, but right where my pointer is at about 112 to 115 range, right in here, it flips blue. You could take that trade with pretty huge conviction. Why? You got a green buy signal. That's 100% win rate. You have a green mean reversion dot. In fact, you had about 7 of them down here. That's a 92% win rate, and the trend flipped, and that's 100% win rate when you're trading based on the trend. So conversely, up here we have the red dots. We've been in a blue uptrend. We've got the red dots. We have a red sell flag right here, and the trend flips orange. Now, in hindsight, it's easy to see what happened after the fact. But imagine you couldn't see anything from right here, where my pointer is, to the right. Let's say you couldn't see any of this because it hasn't happened yet. And this red sell flag comes in. You had a red mean reversion with the mean reversion starting to head back down towards the midline. And then your trend flips orange. You could sell there with conviction. And what would that have been? Let's call it 110 to 200, a 90-point gain, almost 100% gainer. And you take some profits off the table right here because now we're in a downtrend. It's orange, it's orange, it's orange, it's orange. Oh, we've got a green mean reversion dot down here, a green buy signal. The trend flips blue. So we know we can go back in. Up, false alarm. Guess what? You got to be ready to layer on this. You don't want to put all of your chips in because now it flips orange, but we don't sell. We don't get a sell flag. We get the red mean reversion dot, but we don't get anything else. No sell flag. Trend flips down. And down here, what do we get? A green mean reversion dot, a green buy signal, and it flips blue. So now with conviction, we can go back in. We double tap. We bought part here and we buy another part here. So that's how this works. I spent the most amount of time on it because it seems very complicated. But once you figure out that you're just looking for the confluence of all three of those, I've heard a lot of people in the group say there's not enough signals. Okay, if you want to day trade this, just change the time frame over to 1 minute or 5 minutes. I'm not a day trader. I don't like day trading. It doesn't float my boat. I'm not saying I can't teach it. I could teach it all day to Sunday. It's the same thing, but instead of doing these trades over the course of 4 to 6 weeks or 2 to 4 weeks or 4 to 8 weeks, you're doing these trades over hours instead of weeks, sometimes days, right? Hours or days instead of days or weeks. That's the only difference really between the two, but you got to be on it. You got to be looking at it 24/7 if you're day trading it. A couple other tools. IADSS. This is used for one purpose right now, because MicroStrategy is the only publicly traded company that as a percentage of their market capitalization is predominantly Bitcoin. Like Bitcoin makes up the vast majority of their market cap. So you can arbitrage trade back and forth between MicroStrategy, MSTR, and Bitcoin. And the simplest way to show you how this works, whoa, Forrest, if you could mute your line, please. Thank you, sir. The simplest way is down here where Bitcoin, where the MicroStrategy price is below the ARB cloud. In my case, I made the ARB cloud green so I could really see it, right? When the MicroStrategy price, which is this pink line, is below the cloud and way below the price that it should be based on the price of Bitcoin and how much Bitcoin they hold on their balance sheet, that's where you would want to get rid of a Bitcoin and turn it into MicroStrategy shares. Conversely, as the price of MicroStrategy climbs, it climbs above the cloud, above the ARB price. And at this point, what it was telling you is that it should have been priced around $420 a share based on the amount of Bitcoin it has on its balance sheet, plus the intrinsic value of the company. But instead, it was trading at $460. That's the perfect spot to take your MicroStrategy shares, sell them, and buy Bitcoin. And you'll note we've come back down under the cloud. And right now, as of right here, the day I did this, it was at $333 a share, below the cloud, below the ARB price. So this would have been a good time to have done this again, gone from that Bitcoin up here back into MicroStrategy shares. You'll note that I leave on the mean reversion down here at the bottom because it corresponds. Green dot, that's the time I would have taken that trade. Red dot up here, that's the time that you would have taken that trade. Green dot back either here, but it wasn't below the cloud yet. Green dot here, whoops, here, and it was below the cloud. Okay. Some of this isn't making sense. It's okay. We're going to have time for questions at the end. I also train on this stuff individually, one-on-one. Sometimes that's what it takes, okay? IADSS, pair trading on steroids, PTOS. Think of this as a leveraged bet on an inversely correlated assets. Now, that's a mouthful. Leveraged bet meaning you're playing the up and the down. That's why it's leveraged, okay? It's almost like 2x leverage, and I'll explain why. In this case, we're using Tesla as the main asset that we're looking at. The secondary asset that we're looking at here is TSLAQ, TSLQ. That is the short ETF fund that basically goes the opposite direction, polar opposite direction of Tesla, okay? So if Tesla is going up, which it did here, and the trend, the optimized trend, that's what's in blue in this case, this blue cloud, the price is the blue line. As the price is going up in blue, the optimized trend keeps us in the blue cloud. But notice at this point, it reverses direction sharply. That was July 19th. That was the last earnings. I knew it was going to be an inflection point. You'll also note that right down here, we had just been up in this above the red dotted line. This is the other half of the pair trading on steroids. One is signals, one is model. You'll note that right here, we're in a green band. That's an opportune time to sell your Tesla for TSLAQ for the inverse, because it's telling you it's about to go the other direction. When do we do that? Well, here this is telling you to get ready. Here you're getting a red sell flag. However, we don't do it until the trend flips, which would have been right here, right there where the orange mark is. And what was the price at? Well, unfortunately, we didn't capture the perfect top, but it would have been right here at 260. And at that point, you sell your Tesla for TSLAQ shares. So let's say you sold 10 Tesla shares back here at around 270 when the trend flipped. 10 Tesla shares, 270, that would have been $2,700. If I remember correctly, because I did take this trade, TSLAQ was somewhere around 30 or 31, just because of the way that it's the fund is set up. So you would have been able to buy about 90 TSLAQ shares because you sold something that was 270. You collected $2,700. 2,700 divided by 30 is 90. And as the price of Tesla is going down, the price of TSLAQ is going up. And if I had that chart, I'd be able to show you it went up, let's say, to around $36 or $38 a share, at which point, when you get the red down here, it exits the red, the trend flipped right there to blue. At that point, we get out of TSLAQ. Let's say we got, instead of collecting $2,700, we got out of it with $3,500, and we bought back into Tesla, and it's at 240. So instead of having 10 shares, now we have whatever that is, my math, 12, 13 shares. It's a way to increase your bag. Be very careful though, because assets trend up about 80% of the time. Assets go up 80% of the time. This is a leveraged bet. Just be careful with this one. It's a great tool. It's a powerful tool. You can increase your share count very quickly. Your gains, you're amplifying your gains. So if this drop was from the top, it was at about 300 down to 220. I mean, that's an 80-point drop. That's a almost 30% move. But if you went into TSLAQ and you did this, it would have been a 60% gainer, because you would have sold off some here. You would have bought it back, but your TSLAQ shares would have gone up inverse to what you see here on this graph. Kind of complicated. That one's tough to explain. 2 more to go, guys, on the indicators. LILO. LILO is layer in, layer out, layer in, layer out. Very simple. It's a model. I don't know all of the details behind it. I think it's got some Fibonacci retracement in it. I know it has some historical support and resistance levels in it. It's probably got the VRVP in it. I'm saying how it was made. I'm not the guy that developed these tools, but I bet if you ask the developer, I bet those are some of the inputs that were put into it. But what does it tell you? Well, what you're looking for is you're looking to anchor. You'll see this light, this gray dotted line right here. You're looking to anchor this model, this thing that has 1, 2, 3, 4, 5, 6, 7. There's 10 layers. I couldn't fit them all in here, but these 10 layers, you're looking to anchor that at the point where the price crosses up through the 200-day moving average, not down. If it's below, like here, back here, below the 200-day moving average, that's a no man's land. This tool is not as useful there. There are ways that you can set it. Gregism, I know that you've set some crazy ways of doing it, and they work. But for how the purpose of the tool was designed, it was designed for when the price goes up through the 200-day moving average right here. That's where you anchor this. Then you can set the layers to however wide you want. Do you want to see all 10 of them, or do you want to just see maybe the main layers like 4, 7, 9? Do you want to be on an aggressive trading or more of a neutral style or more conservative? And that depends on the asset. Something like Procter & Gamble, you're going to keep on neutral to conservative because that thing barely moves. Something like Tesla or MicroStrategy, you're going to put that bad boy on aggressive because that thing is going nuts, right? That thing moves very quickly. You can also look at a more recent bias or a longer term bias. Those are things where you'll fine tune it. And how do I fine tune mine? A lot of times I'm just taking cues from James whenever he's talking in the group. He's telling you how he sets his, and I know that he's the one that developed these tools, so he's setting them up where he's going to have the greatest chance of success. That's where I do a lot of times copy and try to get mine set up almost identical to his. But you'll see here, look at with predictability. Price comes up. It spent a little bit of time right here at layer, well, actually a couple days here at layer 1. Couple days at layer 2, only 1 day at layer 3, a bunch of time here at layer 4, hit layer 5, came back to layer 4, hit layer 5, went up to 6, came back to 5, shot through 4, 3, all the way back down here to 2, and then came back up here and spent time at 3, at 4, at 5, back down to 4, up to 5. Where is it today? Today it's back down on 3. Because the price of Tesla right now is at about 234 when I started this. Last one, that's how you would use that tool. You're layering in when it comes back down. You're layering out when it goes up to those upper layers. So just to remind you, up here, that's a good place to layer out. You use it in conjunction with the other tools. We got a sell signal here. We had red mean reversion dots here. Right there, the trend flipped. So here at layer 5, that's a great place. If it doesn't hold layer 5, take some off the table. Take a little bit of shares off the table at 272. And as it comes back down again, it hit all the way down at 2. Maybe you set a limit order down here at $220 and it would have gotten filled right here at the end of August. Okay. Last but not least, dollar cost averaging on steroids. Dollar cost averaging is simple. They've said that there's no other better way to beat the markets over a long period of time. It's something I've done for 30 years. 30 years I've dollar cost averaged. Every day or every week, I put a certain amount of money out of each paycheck. Back when I got paychecks, now when I get commission checks, I put a certain amount of income every single day or week, or every 2 weeks or every month, however it works out for you, you buy in. So what that tells you is when you're dollar cost averaging, if the price is high, you're buying less shares. If the price is low, you're buying more shares or tokens. In this case, we're talking about Bitcoin. So we all thought that that couldn't be beat. But what if there was a way to get signals, like in this case, where you don't buy every single day, but you buy on the days when it looks even significantly undervalued? Meaning each of these green triangles that you see, those are days where you would want to buy. The other days where you don't see a green triangle, you don't want to buy. With this tool, you also want to line up that you're in a green zone down here. So that area, that one right there was right on the bubble. So you may or may not have bought in that day. because it's kind of in this red zone. Without this on, I can't tell where that is. But this green arrow, that's down in a green zone. That's in a green zone. This one's right there on the bubble. You might have bought there, but it keeps you out right there. That red, that green, there's a red zone down here. You're not buying that day. You're skipping. You're going to save up your allocation for another day. So if you're going to do $100 a day, rather than doing $100 every day, why not do $100 or $200 or even $300 on the best days to do it? And in doing so, if you bought $100 a day every day for, I guess in this time frame, it was 250 days, right? $25,000 would be 100 a day for 250 days. You'd have spent $25,000. You'd have acquired 1.85 Bitcoin. Your return on investment during this time frame would have been 100%. Conversely, had you used dollar cost averaging on steroids, you would have spent $31,636. So above what you expected to spend on a daily basis. If that's too high, by the way, cut your expected down to about 60%. That's what the experts say on this tool. But in this case, you would have acquired 2.9. So instead of a little under 2 Bitcoin, you would have had a little under 3. A return of 150% on the amount of money that you put in. So you can see it's a way to juice your returns. This scares people when they're like, yeah, but I'm spending more money than I would have. I don't have the extra money every day. Then scale it back. Instead of saying, oh, I have up to 100 to spend every day, set it to 60. Set it to 60 because there's going to be days where it's going to tell you to buy triple. 6 times 3 is 180. So there's days that you're going to buy $180 worth, and there's other days you're going to buy 0. There's days you're going to buy double, $120 worth. There's days that you're going to buy 0. So realize it'll all average out. So set it to 60% of what you normally would. When you put it all together, Gregism, I love it. He said it looks like you're at an EDM concert, right? There's lines going everywhere. There's trends going everywhere. But I unpacked it first so you could see how all this went and played together. Here's those green and red buy and sell triangles. Here's the trend flipping from orange to blue to orange to blue. Here's the mean reversion going from green to red and back down to green and how many standard deviations away it is. Here's that upwards channel that it's been trading within. Here's a new downwards channel that it had been trading within. Here's the layer in, layer out model overlaid. Here, right here is the Fibonacci levels. What I do is I take all those together. Like here, if this is layer 4 and it's the 50% Fibonacci level, that's a strong level. Well, there's a reason why we've traded like crazy around it. I mean, that's basically the level we've been at, plus or minus $50 since June. We've been right here at this 260 level, plus or minus 40 or $50 since June, right? Because this is a strong level. And if we had VRVP on here, remember 200 was a really strong level, 225, and I think the next strongest was around 260. So that's how you put it all together, guys. I'm going to keep flying. I'm way behind. Jeez Louise, I apologize. But I hope this is being helpful. If it is, throw some thumbs up in the chat. Tell me that I'm on track. I'm going to jump into options. And I'm going to go in like you don't even know what an option is. We're going in like brand spanking new. Super simple. An option, financial instrument that gives the buyer the right, but not the obligation to buy or sell an asset at a fixed price by a set date. So there's a couple things in there. The buyer is the one that gets the right, but not the obligation to buy or sell an asset at a fixed price on a set date. Fixed price, strike price, set date, date of expiration. We're going to talk about that in a little bit. They're available. Options are available on a bunch of different things. For what we're going to talk about today, guys, we're going to talk about stocks. Okay? We're going to talk about stocks. Keeping it simple. What are the similarities and differences between options and stocks? Similarities, they're listed options. So options that are listed, they're securities, just like a stock. Options trade like stocks. You can trade them. A lot of people think when I buy an option, I have to wait until the expiration date and then either deliver the shares or buy the shares. They don't realize most people don't hold their options all the way to expiration. They're traded just like a stock is. And we'll talk about that. And they're actively traded in a listed market like stocks. That's what we just said. What are the differences? Options are derivatives. They are derived from the stock. It's not the stock itself that you're trading. It's a contract on top of the stock. Okay. Options have expiration dates. So that contract is only good through the date of expiration. After that, stocks don't have an expiration date. Like when you buy it, you hold it until you sell it, right? Or until the company either goes bankrupt. Hopefully that doesn't happen, but I've been a part of those. But options, they have an expiration date. Like it's done. There's not a fixed number of options. So stock, there's like, 25 million shares outstanding or however many shares outstanding. That means how many shares that company has been divided into. And then you take the number of shares, multiply that by the share price, and you come up with the market capitalization, the amount of money that that company is worth, right? Tesla went above $1 billion for a little while. It dropped back below it. And that was back when the stock was back at 400 and something a share. So there is not a fixed number of options. And lastly, stock owners have a share of the company. So you get dividend rights, voting rights, things along those lines. Options, you don't. You don't have a share because you don't own the stock. You own a contract that's based on the stock. I'm not going to read all this. I'll leave it up there for a second. There's two main types of options. You have, when I say types, you have a call or a put, right? A call gives the buyer, so the person buying, if you go and buy a call, you have the right, but not the obligation to purchase a specific stock at a predetermined price, strike price, within a certain time period, expiration. And the buyer pays a premium to the seller. If it's exercised, then the seller agrees to sell the shares to that option holder, to the buyer. Put, dead opposite. Dead opposite. It gives the owner, the person that owns, that buys, the buyer of the option, of the put option, the right but not the obligation to sell their stock at a predetermined price, strike price. They can exercise that at any point up to the expiration date. They pay a premium. The buyer pays a premium for the right, but not the obligation to sell their stock. And if it's exercised, then the seller of the option contract is obligated to purchase those shares from the option holder or the buyer. That's probably the most important thing. You got to understand, when do you use one? So a call gives you the option to buy up to 100 shares of stock. A put, if you own one of those, it gives you the option to sell 100 shares of stock. What can you do with each? So we have two types. There's two things you can do with each. You can either buy them or sell them. If you're the buyer, you're the option holder, you're in control. You determine whether to exercise that option or not. You are paying a premium for that control, right? The premium is the price you pay to do that. Conversely, you can sell the option. That's also called an option writer. You can write the option. You have to meet your obligation to either buy or sell based on if that buyer exercises their right. You collect the premium. So buying an option, you're paying somebody. Selling an option, you're collecting a premium. But you might have to buy their shares or you might have to sell your shares to them. Okay? And again, we're going to talk about stock options, option contracts for 100 shares. People go, well, what if I only want to do 10? Nope, they're 100. Stock options are for 100 shares. It precludes a lot of people from playing in the options market of securities that are over $100. Because if they're over $100, then a lot of times you kind of need and I'll talk about that, need $10,000 if you're doing certain types of options. Well, you do need $10,000 if you're doing certain types of options, or 100 shares of whatever that stock is. So a premium, like a $1 premium, when we're talking about these premiums, if it's a $1 premium, it means that contract will either cost you if you're the buyer or credit you if you're the seller $100. right? Because it's $1 premium times 100 shares. That's where I'm getting that $100 from. So this was what a lot of you used when you logged in today. You saw this was on the invite. This is, and again, we have people on here that talk about iron condors and butterfly strategies and broken wing butterflies and all that. I'm not going to talk about any of that today. None of that. If that's what you got on here for, you guys can both. I don't mean to be a jerk about it. This is basic. This is so that people don't feel intimidated, so they can start trading options today. Okay. That's what this is designed for. So I'm going to say there's 4 basic things that you can do. You could either buy a call or sell a call, or you can buy a put or sell a put. I understand there's a plethora of things you can do. You can combine a couple of calls with a couple of puts, and I get it. But we're going to keep it very, very basic. The most advanced we're going to get today is we'll talk about what a synthetic long is, because James is always talking about that on our channel. Okay. But here's what your options are. So let's follow the options. Your choices are. Let's follow this down the line here. You can buy options or you can sell options. Okay. When do you buy options? Well, if you expect the stock price to rise, you can buy a call option. You can either go buy shares of stock or you could buy a call option, right? If you expect the price to rise. If you expect the stock price to fall, you can buy put options. I had a guy that I coached do that. He bought a put on Airbnb, and I thought he was a little nutso, but in hindsight, he was spot on. He knew something I didn't know. He knew how bad the Airbnb market had gotten, and he profited significantly on that, like made 50% in a matter of a couple of weeks on a put trade, because he knew that Airbnb was going to come out with some bad news, and they came out with some bad news, right? When I say he knew, it wasn't like insider trading. He uses Airbnbs all the time. He's been an Airbnb user forever. He's been an investor in the company forever. And he just saw that things were heading south, especially with the real estate market and everything else. Okay. So you can buy options. You buy a call when you expect the stock price to go up. You buy a put when you expect it to go down. You can sell options. When would you want to sell options? If you expect the stock's price to rise, you would sell a put. If you expect the stock price to fall, you would sell a call option. Those are very basic. There are times where it may not be perfect. I get it. This is just the most basic ways to do it. So buying options, selling options, this is what you would expect. I'll leave it here for a second. This will be recorded. You could always go back and pause it, take a screenshot, whatever. Okay, so tying it into IADSS, I said, treat it like a stock. Like, think in terms of a stock. Think in terms of trading options. When would be a good time to buy a call or sell a put or do both, perhaps? Well, if Tesla's been on this downward trend and you get a buy signal, a green mean reversion dot, and the trend flips right here, this is a great time right here to buy a call or to sell a put. Because it hasn't gone on. You don't want to buy a call after it's gone on a meteoric rise up to here, because the premiums are going to be through the roof on those. But down here, this is a great place to do it. Same thing with selling a put, and we'll talk a little bit about that in a second. Up here, sell a call or buy a put. Why would you maybe want to sell a call? Maybe you own 100 shares of Tesla and you want to protect what you have, so you sell a call slightly up here out of the money. Why out of the money? Well, because you're expecting it might go up a little bit further, and then bam, it retraces and goes the other direction. Okay. So you would sell a call so that you don't have to give up your shares, but you're like renting out your shares to somebody else. You're collecting a little bit of premium to rent them out. Now, if you were wrong and it went up and you sold the call, then you're obligated, if it's there at the expiration, you're obligated to sell them your shares for whatever the agreed upon strike price was. I'm kind of zeroing in on this 320 level. Let's say it didn't turn down, but instead this went up. Whoops. Sorry, guys. Let's say it went up to 400. You're still selling the shares to them for 320. Just, it is what it is, unless you traded the option ahead of time, which you probably would. But that's what a covered, that would be a covered call. Or you could buy a put. You just think it's going to reverse the other direction. So you buy a put and you say that sometime between now and let's say October, I think this bad boy is going to go down. So you buy a 300 or a 280, a 300 put. And sure as heck, it goes down to 220 and you sell that put and make a huge profit. Okay. Option strat, these may be a little out of order. I couldn't figure out the best order to throw them in. What is option strat? To me, it's become invaluable. I saw James use it one time. It's a way that you can come in here. You go to optionstrat.com. There's this thing called build, and you can build a number of different types of strategies. This, for instance, is a long call. So at the time I did this, Tesla was trading at $259 a share. I was looking at the January 2025, January 17th date of expiration, the contract, the strike price of 260, which is at the money, right? Meaning it's the same, the strike price is what the stock was essentially trading at that day. And that would have cost me $65.79 or $6 per contract. Remember, contracts for 100 shares though, so we have to multiply that by 100. So that would have cost me $6,579 roughly. That's so funny. Those go off all the time for James too. I don't know what, I can't see my trading screen. Somebody tell me what just happened. That was an alert that I had set up in TradingView for something. So that would have cost $6,578. What this tells me is the most I could lose is $6,578, because if I buy a call, I'm plunking down $6,578, betting on the fact that Tesla will go up considerably between now and January 17th, 2025. There's a 35% chance of profit according to option strat. It's not always the best, I don't think, with Tesla. I think I'd have a much greater chance because I'm very bullish on Tesla. Break even, what does that mean? Well, that means that above $325, because that's taking the 260 strike price plus what I paid, $65.79 a share. When you add $65.79 to 260, you come up with $325.79. So anything above that, pure profit, right? But what if it got there sooner than that? And that's why I opened up this range. Like, I believe that Tesla is a minimum $400 stock, but I think it's going to 500 soon. If it's a minimum of a $400 stock and it got there by, let's say, January of next year, I could sell this $6,578 stock option for whatever 10,006. This is profit. So 10,006, about 17,000. I could sell it for $17,000 if Tesla got to 404 a share. This is what it's telling me, is this is predicted profit. You'll notice that as you get closer to the date of expiration, you're losing time value or extrinsic value of that option. That the time is working against you as you get closer. So when you buy an option, if you buy a call, ideally you'd love to see the stock price pop, the underlying, that's called the underlying stock. You'd like to see it pop quick, because if it does, you're going up into the profits even faster than you, and greater than you would if it does it closer to expiration, where there's less time value. It's a great tool to play around with, guys. Just going back there, just go to option strat. There you can change the range, the implied volatility. You can look at the Greeks here. We'll talk a little bit about that, but that's getting very advanced. Again, there's basic options. These are probably the most common ones that I've come across. I could potentially be leaving something out, but the long call, that was what we were just talking about, tells you what it is. Bullish strategy when you think the stock's going up. A long put, a bearish strategy when you think the stock is going to go down, right? That's where you would buy the long call, buy the long put. A covered call, that's a way to generate a little bit of income. Notice it tells you what it is over here. And that's if you're neutral to slightly bullish. So that means if you think the stock price is going to stay about the same or slightly go up or down one way or the other, you sell a call against your shares that you already own, and you're covering that call. You sell that call to somebody else in hopes that the share price pretty much stays the same. You collect the premium and then do it again the following week or the following month, okay? That's a covered call. A cash secured put, as opposed to a margin secured put. Why didn't I put margin on there? Because again, I'm going very basic. I don't think a beginner should be playing with margin in options because it's very complicated and you can get wrecked fast. But a cash secured put means you sell a put with the cash in your account. So what are you doing? You're selling, by selling a cash secured put, you'll get a small premium and the obligation to buy 100 shares if the stock expires below the strike price and you get assigned. So let's break that down. Let's say the stock is trading at $100 and you sell a put at 90 and the stock drops all the way down to 70. Well, now you've got to buy those shares from whoever you bought the put from you for 90. So you had to have, and again, if it was a $90, that means you would have had to have $9,000 cash securing that trade. $9,000 cash securing that trade. Why? Because whatever trade you put on, again, using $100, if your strike price is 90 times 100 shares is $9,000. You have to have $9,000 in your account in the case that you're wrong, and instead of the price going up of the stock, it goes down and you get put those shares at $90. You have to have that $9,000 in there, okay? Again, high level, we're going to go into a little more depth on these. The last one is a long synthetic future. Sounds super crazy. It's a bullish strategy. It is combining this, a cash secured put, and this, a long call. It's combining those two together. You're selling a put. You have to make sure you have the money in your account in case if you get put those shares, and you're using some of that money, sometimes all of it, sometimes part of it, plus other cash to buy a call. That's a very bullish strategy, like extremely bullish, where you believe it's going up and you want to make money on both sides of it. When it goes up, you get to keep all that money in front that you sold the put for, and you sell your call for even more than what you paid for it. So you made money here and you made money here. If you're wrong, the money that you collected for this put, you get put those shares of stock. So you end up with shares of that underlying. So you better hope that you like that underlying. And over here, the call, if you were wrong and the price went down, that call expires worthless and you're out whatever the money is you paid for the call. That's a synthetic long. Almost done. Guys, there's another page that I'm only going to flash up. I'm not reading it. The Greeks. It is very important to know at least the first couple of Greeks on here. Others would say definitely then the next two, and others would say you should know all five. I didn't know all five when I first started. I was able to get started without knowing them precisely. Would my trades have been better had I known them? Yes. But is it essential? Not really. You should just kind of have some idea. Delta's easy. It's how much that options price changes in relation to the value of the underlying security. So a delta of 30, which is 0.30. A delta of 30 means that that stock is, if the stock moves $1, the option is going to move 30 cents. A delta of 50, stock moves $1, the option is going to move 50 cents. It's the easiest way to remember it. Theta is time decay. That's how much that erodes. If you're selling an option, you like theta. If you're buying an option, you don't like theta. And the reason I say that, if you sell that option, if you sell a call, you want that value of the call to decay quickly so that it ends up ending out of the money and you get to keep that entire premium that you sold that call for. Conversely, when you bought that call, every day that goes by that it doesn't get closer to that price that you were looking for is a day that option is losing value. Gamma kind of builds off of that, and off of the delta. It represents the rate of change of delta relative to the change of the underlying security. So it's not just the, if this goes up $1, if the share price goes up $1, delta goes up 50 cents. It's how fast that's happening, the time value in which that's occurring. And then this Vega is, remember, V is easy, V for volatility, how sensitive that option is to volatility. And last but not least, Rho. This was one I learned when I was putting this together because I'd never studied that one. It's the price of an option relative to interest rates. Well, that's been a hot topic over the last 3 years, hasn't it? Going from a 0% interest rate environment to a almost 6% interest, 5.5% interest rate environment. So this is the one I said, screenshot that. You got 10 seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Screenshot that thing because I'm not reading all that. All right. We're almost done, guys. Let's unpack this guy. Okay. This is when you go to trade. This is on TD Ameritrade. This is straight out of my TD Ameritrade. This is when I pull up the option chain. This is what pulls up. There are other dates. Notice this is the Tesla, January 17, 2025. There were other dates in here. I just blacked them out because I needed this space, and you'll see why. I opened this one up, and I only focused on a handful of strike prices that were close to they were close to the money that day. They were near the money. Why? Just for sake of room on this slide, and you'll see why in a second. Okay, so we're going to unpack this thing. You ready? And this slide took like 2 hours to build. It was freaking nuts, but I'm happy. I like it. This is your underlying symbol. This is the asset or the stock that are based out of. So you can change this. You can change this to Google. You can change this to MicroStrategy. You can change it to GE, to Procter and Gamble, to Merck, whatever you want to change this to. You put the symbol in there. Okay. The next thing is, this is the price. This is the price of the underlying stock. Underlying means what's underlying the contract, the option contract. What is it based off? It has to be based off, can't be based off of thin air. We're not talking fiat money here that's based off of nothing, a handshake. That's a dig at fiat. We're basing it off of something, right? It could be gold. It could be silver. It could be Bitcoin. It could be whatever. In this case, it's Tesla. That's the underlying symbol, and this is what the price is. The highest that somebody was willing, I'm sorry, we're going to go there in a second. Chain type. This is calls and puts. You can look at calls alone, puts alone, or both. I like to see them both at the same time. So it splits this pane where you have calls down the left and puts down the right over here. So that's how I like to look at it. You figure out what's best for you. Range, in the money, out of the money, near the money, or all of the above. I use all, but I couldn't fit it in here for an example. I like to see what are all the strike prices trading for. So I see what all of my choices are. I try not to use the word options, but all of my choices are. Okay. And I'll explain what these are in a second. Expiration, all are specific dates. I choose all, and then I expand the date that I'm looking at. So I chose all the expiration dates, and then I zeroed in on this January 17th, 2025. Strike, you can choose a specific strike price. If you wanted to just go look up the 250 call, you could throw that in there and look up the 250 call and put, you could do that. I wanted to see the range. I wanted to see all of these different options, not just the one. Then click view chain. Once you've put all these choices in, you click view chain. This is the option chain, guys. This thing down here at the bottom, this is what it looks like. It could be a much longer with all the different contracts in there. Again, this one has 6 contracts listed, just what fit in there well. Calls down the left-hand side of the grid, puts are down the right-hand side of the grid. This is called a side-by-side view. You could also have a stacked view where they're on top of each other. It's whatever you get used to, right? This is what I'm used to looking at. When I look at the other ones, it takes me a second to figure it out. This I can look at and quickly go across and know exactly what I'm looking at. This is the date of expiration, the DOE. And options expire at the end of the trading day on Fridays. I was supposed to say, oh yeah, options expire at the end of the trading day on Fridays. The monthlies, it's the third Friday of the month. So there are, on some stocks, not all, but on many of the bigger stocks, there are weekly options. On indexes, there's even daily options. But for what we're talking about on your normal stock options, there are weeklies and monthlies. All of them expire on Friday. The monthlies expire on the third Friday of every month. Weeklies expire every Friday of the month. I hope that makes sense. Strike price. Let me move this. Hopefully that's not in the way. I'm going to move that up just in case if it is. Strike price. That's the set price at which the owner of the options contract can buy or sell the underlying stock, the exercise price. So you'll hear people talk about the strike. This is where the options contract will execute. At what price? Okay. So the stock right now is trading at 258. We'll call it 259 in this example. Wish it still was, but it's not. It's down from that today. So the strike price of 260 is the closest to being in the at the money. Contract name. You'll often hear people say, like, for instance, the January 17th, 2025 Tesla 280 calls or 280 puts. That's what they're referring to, is this right here. It's, if I clicked on that little arrow that's next to it right here, it would expand out and it would say January 17, 2025 Tesla 280 call. That's the name of that entire contract. What's the bid? The bid, just like a stock, the bid is the highest price that somebody is willing to pay for this contract right now. $57.55 a share. Again, math geniuses, what is that total? $5,755 because it's for 100 shares. Ask. This is the lowest price that somebody is willing to sell the call for. Okay? $57.80. The spread is the difference. So in that case, it's a spread of 25 cents, which is not much at all. That's a narrow spread. When you think about it on a percentage basis, you're looking at 0.5%, I think. If my math is correct, it may be off. So what this means is that somebody is willing to pay $5,755 for this, and somebody is willing to sell it for $5,780. There's a slight difference, and it will typically, what you'll see next is last. Usually is the last price that it was bought for. Sometimes you'll see, I mean, last always is that. Sometimes right here, you'll see midpoint instead. And the midpoint is the midpoint between the bid and the ask. Okay, so sometimes this column on certain trading platforms will be the midpoint. Others it'll be what was the last trade. In this case, it was the last trade. So the last option contract, this 280 call, went for $57.65, $5,765. Okay. Change. I jumped over here because I ran out of room, but change is the same here as it is here. That's the change in price from the previous trading day. You can look for anomalies here, right? Like the 280 put is up 68 cents. The 270 was up $1.10. This was up $1.24. So if you were looking to sell something and it was up, you may want to sell something that was up considerably more. Vice versa, if you're looking to buy something, you may want to buy something that seems like it's down more than it should be. Like this, you know, maybe this 250 call looks to you like it's down more than it should be, or the 280. But that's what the change is that, you know, yesterday, this, instead of being 61.55, it was whatever that is plus 68 cents. Volume is the number of contracts that were bought and sold during that trading day, just today. So at the point when I took this picture, one of these 280 puts had exchanged hands that day. 989 280 calls had exchanged hands that day. Last but not least is open interest, op interest, OI, open interest. It's called all three of those things. It's the total number of contracts that are open for that particular strike price and date of expiration on that contract. It gives you an idea of the liquidity. So like this 260 call, there's only a grand total of about, we'll call it 3,000 contracts out there. But the 250, there's 12,000. So you'll have a lot easier time moving this. You'll also notice a much narrower spread usually when there's a lot more open interest than when there's a lot less open contracts out there. So again, to reiterate, this was one contract today, but there are a total of 3,783 on this 280 put. These were, I said, we were going to talk about in the money, out of the money, at the money. ITM, in the money. These calls are highlighted in yellow. They're in the money because the underlying stock's share price was above the strike price. What does that mean in English? Remember the share, the stock, can I call this 260? Hopefully you guys are cool with that. It's trading at 260. This is a 250 call. That means it's already $10 in the money. That means you could buy 100 shares of Tesla for 250 bucks a share and immediately sell them for 260 bucks a share. It's in the money. At the money, 260 calls are at the money because that's the closest or equal to what it's trading for. It's trading at 250, 258.87. We said we're going to call that 260. 260 call is at the money right there. Last but not least is out of the money. These calls are white because the underlying stock share price, these calls, underlying share stock price is below the strike price. Meaning, why would you want to buy 100 shares at $280 a share when you can buy them at $258.87? These are out of the money. Now it gets tricky. Puts, flip everything you just thought about upside down. Flip it upside down. The white here are out of the money because the underlying stock's share price is above the strike price. Again, why would you want to sell somebody your shares at $230 when you can sell them your shares at $260? You'd be an idiot. At the money. These 260 puts are at the money because underlying stock share price is equal to. We already established that on the other side. At is at no matter what. In the money. Why are these puts in the money? Well, they're in the money because the stock's share price was below the strike price, right? So right now, if the stock is at 260 and you got a 280 put, that means you can sell if you owned one of these contracts, you could sell 100 shares of Tesla for 280 bucks. And you're netting $20 over what they're actually going for right now. So these are in the money puts when the price is below. Put, if the price is below, they're in the money. Call, if the price is above, they're in the money. Easiest way to remember it. Screenshot that. Ready, go. 5, 4, 3, 2, and 1. Because it's pretty intimidating when all of a sudden, there's the, what I was telling you. See how right here, these are all the other strike dates, all the date of expirations. But it's pretty intimidating when you don't have the cheat sheet, right? Now you're looking at this, but I wanted you to, when you look at this now, it should make sense to you. Underlying stock, calls and puts, near the money, expiration, I'm showing all of them. We don't care what the strike price because we want to see them all. We hit view chain. We've got Tesla. It's trading at 258.87. Here are all the dates we could have pulled up. I happen to be looking at January 17, 2025 because it's more than a year out. That makes it a leap. Leaps are basically when you're looking at an option that's over 1 year out. Why would you do that? Capital gains. You drop down from a short-term into a long-term capital gains tax for those of us here in the United States, especially. So we're going to practice. I have one last slide after this, but these are the things that I'd like to talk about. The long call, the covered call, keep your clothes on. Why? Because don't go naked. Put a naked call. Most of us don't have those privileges in our trading accounts anyway, but what that means is that you could basically just sell a call, even if you don't own 100 shares. You talk about dangerous, it's unlimited risk, because if you're wrong and it starts going up and you have to cover that by buying those shares, it's unlimited loss. Unlimited loss. I do not do naked options. I keep my clothes on. That's what makes it a covered call when you own the 100 shares. Can talk about a long put. We can do cash secured puts. Again, not a naked put. Naked put is, again, if you're selling a put, but you don't have the money in there to cover the number of shares. If you get called out and you're wrong and you got to turn around and go buy those shares and you don't have enough money and you're trying to do it on margin, all of a sudden now you got to start selling off other securities. But what if all of your stocks and everything that you have, all your money is in stocks, and all those stocks go down at the same time? You need to generate money to buy these shares from a naked put. You could wipe yourself out. So always make sure, in my opinion, for a beginner, always make sure you have the cash, and then a synthetic long, or an SL as James calls it. So here's like where you could potentially do what, right? I did this one here. I did buy a long call right here on August 21st when Tesla had rock bottomed. Why? It was hitting the bottom of this channel right here. It was hitting layer 2 right here. Fibonacci retracement level of 38 right here. The trend had been down and it flipped up. I got a green buy signal and I got a green mean reversion dot down there. I mean, it's so many things lined up that it made sense. At the time, I did not have 100 shares of Tesla up here. I'll be honest with you guys. I just didn't have them yet. I was acquiring them in this range over here. But had I had 100 shares right here, I would have sold a covered call. I would have sold a call at about 310 or 320, probably a little bit out of the money, because I could have done it with conviction. Why? We're at the 61.8 Fibonacci level right here. We're hitting the upper bounds of this channel that had already been put in place back there. We're hitting the upper bounds again. Earnings were that day, and they were projected that they weren't going to be great necessarily. We're coming up on layer 6 on the model. I get a red sell triangle, and I get the blue trend flipping over, and I got a red mean reversion dot. Again, what is that? 6 different indicators telling me that that's what I should have done. Okay, but this gives you an idea of, just on this security, where you would potentially want to do what. When you get a buy signal, buy a long call. You could enter a cash secured put. You could enter a synthetic long, which is selling a put, buying a call up here. Again, these are basic strategies. I know there's a million ways this Sunday to do, call ladders and different call spreads, put spreads, butterflies, iron condors, broken wing butterfly. I get it. Guys, it's not what today is designed for. This is for the beginner. I don't want to intimidate anybody. But here, sell a covered call, buy a long put. Down here, buy the long call, et cetera, et cetera. So, and that's what I did. That was my actual trade on January. I bought the January 17th, 2025. So here's the contract. The January 17th, 2025 Tesla 230 call, which was right about at the money, slightly in the money at the time I did it. And it cost me $61.29. That thing's been as high as over 90 bucks, right about here. And today, now that we're down about kind of over here, it's only worth a little over 7,000, but I'm still up on it because of using these tools. All right, this is my pitch at the end, my little pitch. If you want any of those other tools, TradingView, you go to tradingview.com, optionstrat.com for the options stuff. Invest Answers, go find his website. That was on one of the very first slides, where you can go and you can join our Patreon group. You can go and grab some of these paid indicators and get them set up on TradingView. There are owner's manuals. There's videos about it. There's a million different things teaching you how to use all of these tools. What I found was I found people reaching out to me because I understood the tools and I know how to teach them. And as a result, I've started to book private appointments with people. I've already worked with about 15 people in our IA community. No, it's not free because I put a tremendous amount of time and effort into this. And I know you'll find value in it. Here's just a few examples down here. I didn't use full names because I didn't ask any of these people for permission. If any of them are on here today, they'll know who they are. But, you know, thanks for such an amazing training and your extra efforts tailored to me. I'm very lucky to be working with you. I don't think I could find better for any price. This week, I set up some pair strategies. It sure seems like the upside is there. By the way, that guy has already made some 5-figure days on his pair trades. 5-figure days. This guy, thanks, mate. I checked it. I checked them. I think it was supposed to say them. Thanks, mate. I checked them the other day, but I need to set alerts. I said, correct. You paid $782 for it. Because I sent him a quick text saying, hey, remember that put trade you put on? You paid $782 for it. Now you can sell it for $11.08. You'll profit $326. And he just fist bumped me back. That's a cool, 50% gainer. And then I started building out my TradingView today. I really appreciate you taking the time to work with me on that. Finally understanding this stuff. Best damn $200 I've ever spent in my life. So take a picture of that. I can always put that back up. I'm going to stop the share. Hopefully we stop the steal here in the United States. You guys know what I'm talking about. Stop the share, stop the steal. I hope you guys found value in that. I went way over. I told you I was going to over deliver and under promise. You can't do all that. I should have broken it into 2 separate things. In hindsight, I see some questions. Option strat range and why did you set them at those positions? Great question, Dave. I'll nail that one first since it was typed in here. The range I set there because I believed, let me go back, range and implied volatility. Let me just go back to that slide if that's okay with you guys. I'm going to go back. I'm going to share. Oh, where did the slide deck go? I'm not seeing it, man. I'm tired. I don't see it. I don't know why it won't let me share that right now. But what I'll tell you is I don't want to share. I set the range where it was because I wanted it to go up to $500. So the range, all that is it's looking at what did I think was possible over the time of the option that I was looking at. Well, I was looking at an option all the way out to, remember the example I gave was January of 2026 on Tesla. It damn sure better go over $500 between now and then. And I'm not sugarcoating that. So I believe.
I agree.
Right. So I could have set the range up to 1,000. I could have set it up to James's 8,000 target, but remember, we're not getting there till like 2032 or further. But I set it there saying, okay, I want to see what would my potential profit be between here. And you know what? Let's go. Let's do this. Let me just see what I have open. Oh, nope. Yeah, I'm not going to keep that page open. We'll keep this one open. And now we'll share the screen. Dadgummit, get back here. Oh, it was still there. I had never stopped sharing. Come on. Zoom. Share screen. I feel like James in a way when you're trying to run all this stuff. You guys see this option strat right here?
Yep.
Okay, so these are like, you can save your trades. I saved some of James's to see how they do in the long run. Some of mine are test. Here's an actual one, so I can take a look at an actual one. But let's say I want to build one. We'll just go up here to option strat, build. We were looking at a long call. We were looking at the Tesla. Again, it's changed. So I'm going to look at the 240 right now because to make it equal, we were looking at a 260 when it was at 260. And we're looking out at January 2026. So the range, notice, Dave, as I change it, all it is changing how far out we look. You could go up to $1,000 if you think it's going to go to 1,000 in that time frame, or you can run what if scenarios. Like there, I stopped it right at 1,000, and these are perfect $50 increments. I don't think I could do that again if I tried. That was just luck.
Gary,
Yes.
can you maximize your screen?
Yes. File. Oh wait, it's. Oh, do I need to go to full screen? Maybe.
Yeah.
Hang on. Let me admit.
Does F11 do that?
I have a Mac.
Oh, don't worry.
I'm just hitting volume. You can't. Is it because you can't see what's underneath here? Like, if I move that out of the way.
Yeah, you were talking about the range, and it's at the bottom of the screen. I think everyone saw it before, but I just figured you could share the whole thing. But
sorry, what if I move that? Oh no, that doesn't help. Yeah, I don't know how. I don't know how. I'm not seeing. Usually, there's a little button up here that tells me how to. Oh, view. Full screen. That better?
You can see more now.
Okay. So here's the range down here at the bottom. There's a slider. See if I could do this again and nail it down. So at 1,000. No, I'm not. Yeah, I got it. So what this is saying is, as we're going out in time. So if I paid $8,456 roughly for this 240 call, and I believed, what is this strategy? Again, I could just hover over this question mark. It's when I believe it's a bullish strategy. It's when I believe it's going up. What if it got to what for poops and giggles? What if it got to $1,000 and it did it by January of 25? The profit on this option would be almost $69,000. $68,000 or $69,000. Okay. But what if it only made it to $500? And what if it got to 500, not by January of 25, but it got there by June of 2025, like almost, or October of 2025, 2 years from now, you'd profit 22,800. That's what this does. The range, you can just look at, if you're like, man, it's not going above 400, maybe you just set this in tighter. And you look at what where do you start losing money? Like right in here, where do you start losing money? And this bases it on time decay and everything else. Implied volatility, a lot of times I just leave it wherever they recommend, whatever option strat recommends. I feel like their analysts are probably smarter than me, but you can play with that if you think there's going to be more or less volatility. I just left it right here, right around the 1 mark. I don't change that a lot. As I scroll up, now I see why you guys couldn't see the bottom. That's my bad. I could do this too. I could do command and make it smaller so it all fits on the screen like that. You can change this over to one of those graphs. I like the table personally. You can look at what your profit and loss percentages are, what the actual contract value is. What does contract value mean? Again, guys, let's use this $402 line, and let's say it got there by January of 2025. This is telling us this contract would be worth $185, but we have to multiply that by what? 100, which would be $18,549 that you paid $8,456 for, or a profit of right around 10 grand. Watch what happens when we go to profit or loss. It's a $10.1 thousand profit. So it's just different ways of looking at it. You want to look at the percentage you're up, what the actual contracts are selling for. You can also look at your delta, how the delta changes, how the theta changes. Remember theta, that's how much that contract is losing per day in dollars. But again, that's exact dollars. That's not per share. So it's not like it's losing $7 or 700. It is literally losing 7 a day. For instance, at this point right here, you can look at the gamma, you can look at vega, you can look at rho. I mean, you can look at all of the different Greeks. The other thing that I use this for is James bought, somebody remind me of what the exact contract was. I think he bought this one. Was it a January Didn't he buy a Tesla contract today? You guys
Yeah, it was
remember?
the 200.
200?
Yep.
January 26th one?
Yep.
Okay.
For like 103.50 or something like that.
Thank you, dude. Thanks, Bob. I appreciate it, bud.
You bet.
So, and so it's right now he's down. It's 10. So it's 102.16. So he's down like $1 or 1 times 100 bucks right now on that. But when he did that, what I did was I came up here, see the historical chart. I clicked on that, went and set it to 1 day. And he put that announcement out around 12:45 because I know I was on my bike trainer at the time. Funny thing is, can't make this up. There's his like right there at like 103.30, I think. He was thinking it was like 103.33. So there's James's trade right there. So you can see what's the value of the option contract since its inception, for instance. So since this one's been available, this January 200, the January 16th, 2026 200 call has been available since about the beginning of September. It's been as high as $130, or that would have cost you $13,000 for that, and as low as 102.54, and now today 102.15 currently. So that's the lowest this option contract has traded for since its inception, is where we're at right now. You can see it right there, plain as day. So that's here under price history, and that's the actual option up here. The underlying, what's the underlying? The stock, and there's your IV. There's your implied volatility, Dave, at the very bottom. Option strat, I just got an announcement that they, let me see everybody's mugs again. There we go, so I can see some faces. I hate looking at this. You know what? I'm gonna stop the share because I can always go back to that. Breakdown of synthetic. Yeah. Option strat just raised their prices. I just got an announcement yesterday from 150 a year to 200, but 200 bucks is, I mean, if you're going to trade in options, I almost said play with options. I wouldn't play with anything. But if you're going to trade in options, it's well worth it.
This might seem a bit of a stupid question, but do you keep this at the end of it? You get your shares back, right? You don't ever lose those shares, or is it cost?
Well,
you have to have 100 shares to make the trade.
No, you don't. Good question. I'm going to share again. I know I'm going to keep coming back and forth because I like to see people's faces, guys. I'm sorry. I look at a screen all day, but let me come back here and I'm going to pop back in and out. Let me break down on a long call, and let's break down James's exact trade. Okay. Start from the top. A Tesla. Now, Tesla's trading at a different price than when James did this, but here's Tesla. We put in the underlying. We choose our date. His date of expiration was January 16th, 2026, right? So, I mean, it might have been set over here. Bam, I set it to here. Strike price, I slide this. If it doesn't go far enough, you can you can move the whole scale if you need to. See how I'm moving the whole scale by dragging it? But he did the 200, so we're going to settle in right there at the 200. And he took the trade. Notice when I clicked on it, it opened this. Watch. Click. His was 103.33, if I remember correctly. Bob, I know you're going to know it down to the penny.
103.30.
30. Okay. I usually have a photographic memory. I knew there were threes in there. Thank you, sir. So I put that in. That's James's exact trade. Okay. And he did probably 100 contracts or some stupid knowing him, but I do one. I'm normal. I'm a mere mortal. That was why I wanted to teach this. And I kind of had that conversation with James the last time he interviewed me. I'm like, what he does and what the average person do are very different. We can mimic him, but if he does 100 contracts, just cut it by 100%, cut it down to 1. And now you're back down to our level, right? My margin I don't have unlimited margin. I don't, sorry. So one contract, he paid $10,330 for it. You follow me, Dave? And you can leave your, you can stay.
100%. Okay, cool. 100%. Yep.
Okay, leave it on. I was gonna say you can leave unmuted since I'm doing your question right now. Okay, so 103.30. And now I can just click anywhere outside of this. Notice when I clicked somewhere out there, see the little blue dollar sign right there. That means that we actually did this, and I can save this trade. So I'm going to save it. I have my little system that I use. That's what he did this day. James bought for 103.30, just so I remind myself, where am I going to put that in my test trades and save? So now I can view my saved trades, right? So when James does these, this is how I learned, guys. Recreate it in option strat. If you can recreate his trade in option strat, you know you get it. So where's his trade? Right here. I can tell right away, I can see he's already down 115 bucks on this per contract, but he still has 2.2 years. Guaranteed he won't be down on this by the time it's all said and done. He won't. He doesn't lose. Guy doesn't lose. I can pull that right back up and it looks exactly the same. And now I can look and see his net debit was $10,331. Right? Because what it's doing is it's taking into account the cost of each contract. I think it's like 60 or 70 cents. For me on TD Ameritrade, he uses TD Ameritrade, now soon to become Schwab. For you, it might be different, you know, but that includes, net debit includes the price of the actual trade itself, which is under $1 each way when you buy it, when you sell it. So that's that. So right now, Dave, he owns 0 shares. He owns no shares of Tesla at all. He didn't have to own any to do this trade. He didn't have to buy any to do this trade. To buy a long call, he just had to have, he doesn't even have to have margin in his account. He just simply had to have $10,331.32. Okay.
Got it.
Right. So,
and somebody out there in the world was silly enough to buy that, then, I guess. Is that how it works?
Somebody out there was silly enough to sell it. You got to work on your verbiage. This is something, again, it's something I coach on. If you don't ever feel confident going into trades, you tell me what you want to do. I won't tell you, go do this or take this or do that. You tell me what you're going to do, and I will tell you whether your verbiage is correct or not. I had a guy saying that he wanted to sell a put. And I'm like, no, you want to buy that based on what he was trying to do. On the contrary, I had somebody say, well, somebody else bought the call. I'm like, no, you bought the call. Like what you just said. I'm like, no, you bought the call. And yes, somebody was silly enough to sell that. Why? They're maybe balancing out another trade. And again, options, a lot of the more advanced options traders are doing X amount this direction and X amount that direction, balancing them out. They're playing within a range. They think it'll trade within a range. It could be part of a call spread. There's a number of different things that number of different reasons. But for you, what you're focused in on is you need this sucker to close above. Really, you need this sucker to start moving north. If it closes above $303 between now and January 26, you've made money.
I think that's a given.
Right. If it gets there faster, you don't sit there and I don't sit there and hold this sucker all the way to the end. If it looks like it's topping out, again, I'm using IADSS along the way, Dave. I'm using all my tools at my disposal. The fib levels, the layer in, layer out levels, the confluence, the mean reversion, the trend, all the different tools I have at my disposal, the numbers that are coming out, the fundamental analysis, the numbers that are coming out in their quarterly earnings, whether or not this FSD comes to fruition, whether or not the Cybertruck starts delivering next month, all those things factor into your decision. If this sucker all of a sudden goes to 430 and it does it by January of this upcoming year. I'm sorry, January a year from now, so 15 months from now, and I think it's starting to lose steam. Like it's just been on this rocket ship, and then all of a sudden you see that inflection where you're like, okay, on the daily it flipped, like on everything it's flipped, and now it's starting to head south. Sell that call. Take your $14,000 profit, aka your over 100% profit, 140% profit. Wait for it to come back down and then turn around and buy it back, or buy back a different one. You see what I'm saying? That's the whole trade.
I understand. Also, your money's not as tied up for as long, I guess, either.
No. Now I'm going to show you the synthetic long, though. So James's synthetic long, 10-4. James posted. So I put notes in. I entered it this. So I guessed. I reverse engineered it to get the trade approximate, but based on what he said, he entered it 349, bought the 250s, sold the 250s, break even is 380. So I figured about what he did and I recreated it. So what did he do? Oh, and this is on CleanSpark. So what did he do? CleanSpark, the January 17, 2025, he said he did an SL, a synthetic long. What's a synthetic long? First thing he did right here. Of course, it's not going to open. It does this to me sometimes. There we go. He did way more than one contract, but this is on a per contract basis. He sold one $2.50 CleanSpark put for $1.10 or $110. Selling it, that means he netted, he not netted, but gross, collected $110. You with me? Then he turned around and used that money. Come on and open. Oh, geez. Give me just a second. If you ever mess it up, go back to the save trade. Sometimes this won't open. There it goes. You have to click like perfectly. That's a complaint that I have with Option Strat. Then he purchased, and again, I reverse engineered this so it would come out. He purchased the $2.50 call for $2.40. So his net debit would be what he collected from the put, what he paid for the call. The difference in the two is 133 or $4. The reason for the 132.64 is I have my option strat set up to calculate the cost of a contract. It's like 66 cents each way. 66 cents to sell one, 66 cents to buy it back. And since this is a total of doing that 4 times, right? Because you sold the put, you're going to buy it back. You sold the call, you're going to buy it back. You're not going to let them go to fruition is what we're assuming. Okay. That's why that's what it is. Don't worry about the estimated margin. That's other people's margin. I'm doing a lot of my stuff in an IRA, and IRA gives you 0 margin. It's not marginable. I know you guys have different things in the UK. You may be in a brokerage account that does allow margin. What you need though, what would you need if you sold the $2.50 put? Meaning somebody could put you their shares at the strike price. How much do you need to have in reserves just in case?
So I need the cash to cover it. So that's 100 times £2.50. Is that right?
Yes, sir.
Or $2.50.
2.5 quids.
Yeah.
As my buddies over there, as my mates over there call it, 2.5 quids. Yeah. So you need $2.50 times 100.
Because I don't want to go swimming naked.
So or else you're swimming naked.
Yeah, got it.
And I don't want to see that.
No one does. No.
I don't know that there's anybody in our group that I want to see that.
No.
So yeah, so that's where that dollar figure is coming from. So what do you need to enter this trade? Mere mortals, normal people that are not going in with heavy margin and everything else. You need upfront $250 locked away in case you get put those shares, plus the 130 some odd dollars, $132.64, basically 130 bucks. So you need $382.64 to execute this trade. What's the most you could lose? Well, imagine that right there. How did I calculate? But I broke it down for you. I calculated it. If you got put the shares and had to buy them at 250, I don't care if the share price is at $1. You're buying that person shares for 250 because you sold them the right, but not the obligation. You sold them the right, but not the obligation because you were the seller. You were the writer. Up here, you were the buyer or holder. Those are all just different terms they use. Chance of profit on this is over 50%. So this, James knew this is a great trade. Like, is CleanSpark going to go above $3.83? Hell yeah. So what this means is on every single one of those puts that he sold for $1.10, chances are 110 bucks. Chances are he's pocketing that money. That's a done deal. So you do 10 contracts, that's $1,100. On the flip side, the money that he paid for the call, the $2.40, that'll likely go up to say $10.
Yeah.
Takes out his cost. That's $7.50 or $750 per contract times 10 contracts is $7,500 plus the $1,100 he got from selling the put is $8,000 and some odd dollars. That's where he gets these crazy astronomical percentage returns. He'll probably go back and watch this. James, you and I both know that that is statistically correct. But in a way, it's a little misleading because you had to have that money available either on margin or as a cash secured put. You had to have that money back there in the background. So though you only spent on this $132 per contract, you still had to have $382 in order to do the trade or the equivalent worth of margin, which means I build that into what my percent gains are, not just what I made on what I spent for the option itself. I hope that makes sense. We took a lot of time on that. I'm going to jump in. Where's the question and answer? Synthetic.
Go up to build and show them where this is on the build schedule.
Yes, I will. Besides
the only reason why is because of the level that it is.
Oh, a great point. Thank you, Bob. Thank you. I can't see your face, but I know your voice from chatting with you a bunch. So notice here. Oh, there we go. Here are your novice strategies. Where would I swim if I was doing options to begin with? I would stick with long calls, covered calls, cash secured puts at the most. Really, I'd focus on long calls and covered calls first. Long calls, we've talked ad nauseum about that because that's just a way of controlling 100 shares of stock for less than the cost of 100 shares of stock. The risk is you lose everything. You're not stuck with shares that have lost value. You're stuck with a options contract that could be completely worthless is the risk. Hence why you don't necessarily want to buy one super far out of the money. I do have a guy that I coach and he does that and we argue about it. It's your risk tolerance. I don't have, I buy calls in the money. So does James. Long put. I might do that after watching that guy have some success with it, but I got to know that that sucker is going to go down. Covered call I did on Google. I'll show you one. And then a cash secured put we just went over in great detail. By the way, long synthetic future is all the way over here under expert strategies. Hence why James is teaching an expert strategy. It's a simple strategy, but you have to be sure you're covering both sides of the equation and you're keeping a look on both sides of the equation. And here's all these other crazy ass names that I was telling you guys about: iron butterflies, iron condors. And you could ask me, hey, what's this or what's that? I honestly don't even know, like jade lizards and reverse jade. I honestly don't even know what they all are. I've probably done a trade that involved something like that. I just don't know what they're called, like, because they put all these fancy names on, but they still involve the same thing. Look, a jade lizard sounds crazy, right? But it's still selling a put at strike A, buying a call at strike C, and selling a call at strike B. What did you do? You sold a put, sold a call, bought a call. That's all you can do is you either buy or sell puts or calls. And then you can put them into all these crazy strategies based on whether you think it's directional, neutral. There's all kinds of strategies with it. Stay over here. Whoops. Stay over here. And Bob, thank you for reminding me to do that. I'm going to stop the share. I want to share one thing because covered calls are the ones that come up all the time that people are always asking about. This is TradingView here. You'll see me looking to my left. This is where this one is. Can you guys see that? So this was a good sell of this is on Google. I own over 100 shares of Google. So I practice all the time. I mean, what do I got to lose? Here's my cost basis on my graph. Notice my graph. I have the layer out on there. I have an upward channel. You can see the pink line right here. You see the fib level in the background right there. There's another fib level right there. I drew this little box in. This is the date of expiration. So what did I do? I sold a call here when I thought things were top heavy. It dropped. It gave me a buy signal. So I bought that call back. So I sold the October 20th. I sold a short dated, a weekly, October 20th, 145 call for $1.30 or 130 bucks. So I debited $130 in order to take this trade. Dave, going back to your question about owning shares, I had to have 100 shares of stock in order to do this, to make it a covered call. Somebody might correct me and say, oh, well, you could do it naked. I don't swim naked. I keep my clothes on. Nobody wants to see that shit. Excuse my language. Stuff. But then I bought it back. Why? Because I had a buy signal. What do I do when I have a buy signal? I could buy a call. I sell a call when I have a sell signal. I didn't get the sell signal up there. I'd gotten it back here. But the trend kind of kept coming up, and all of a sudden it plummeted, and I'm like, I'm doing it. I'm doing it. It's turning. I know it is. It's turning. It's right here around this fib level. I thought it was going to retrace at this fib level. And sure enough, it flipped and started going back up again. I bought it back for 19 cents or $111 profit. So technically, if I sold it for $1.30 and I bought it back for 19 cents or $111 profit, I could say that I basically made almost a 90%, 80-90% profit. But I also had shares in the background that were on the hook if the trade went the other way and they had taken those shares away. So that leads me to the new one. And I'm going to move this over just so that that other one kind of goes off the screen. The new one, I jumped the gun. I got excited and I'm like, you know what? It flipped. It started going back up. And because it was going up pretty violently, volatility was up, which you want to sell vol. So I sold some volatility and I was able to sell the 145s for $2.30. Remember, before I was only able to sell them for $1.30, but it was a short dated one. This one I went out a month and I'm like, I'm going to a little over a month. And I'm like, and I'm going to sell these for $2.30. So I'll collect $230 premium. And then it just kept going against me. What is this little range I drew? This little range is where I would make a 100% profit. Meaning if it closes, if the price stays in this box up to this red line and over to this red line, and it just stays and plays around in this area, I collect that full $2.30 premium. I don't have to buy it back. It expires worthless. And I keep my shares. Why did I do that on this trade? Because I'm willing to part with my Google shares right now. Why? My cost basis is $126. This is at 145. That's almost $20 a share plus the $2.30 a share. That's $21.30 a share profit times 100 shares or over $2,000 that I'll have made in Google on these particular shares. Since August 21st was when I bought that lot of 100. So I'm willing to, oh, doggone it. Hey, Google, stop. I have a G hub, smart hub on my desk, and it heard me talking about its stock. So I'm willing to part with those shares. Why would I be willing to do that? This is me. This is my strategy. It doesn't mean my goals are not your goals. And you saw me post that in the group today, blah, blah, blah. Google served me well. I really want to juice up my MicroStrategy holdings. I have quite a few shares of that, but I really want to juice it. And I'm going to roll this money straight into some option strategies on MicroStrategy, because I believe there's bigger money to be made faster on option strategies at a time when the vol is just going ballistic right now. You know, we got people saying that ETF got approved and then it didn't get approved, and et cetera, et cetera. Let me answer this question. Besides tax purposes, how would you determine expiration date? Mike, thanks for hanging on, dude. I think you're still on here. I hope you are. I'm going to pull out there, see if I see your shiny face. Oh, Mike jumped off. Weingarten's off. But I'm going to answer that. So expiration dates, because he can always go back and watch the recording. Expiration dates. Why did I choose one over another? Well, when I'm selling covered calls, I'm typically choosing a shorter time period, right? I don't want to sell a covered call all the way out to January 26 or January of 2026, because that means that I'm renting my shares to somebody for the next 2.2 years. Those shares I can't do anything with them. That lot of 100, what if the price tanked in the meantime? Well, I'm stuck. I either got to then buy that call, that covered call back. So I'll sell short-term covered calls. I buy longer-term calls. If I'm the buyer, I'm buying longer-term ones. So I have a longer time period for that to play out. Same thing with the synthetic long. You'd want to do that out for a longer time period. You can do shorter ones. They're riskier. You're basically then paying more money and getting less time for it to transpire on a like a synthetic long or buying a long call. But selling a covered call, I kind of want, like, going back, if I was still sharing my screen, remember how on Google I had that red box? That vertical red line can't get here soon enough. Like, I want the time to pass quickly. Whoever bought that call from me, they're praying that the stock price goes above 245 between now and then, and they're going to get a bargain. Me, on the other hand, I'm praying that stock price stays at or below 145 between now and November 17th, which is now less than a month away. But I told you guys, I'm okay. If those shares get called away, they get called away for a tidy 15% or so profit, right? Whatever 2,100 over my original cost basis of 12,000 is. 17%-ish. I'll take it. 17% a month. Sure. James talked about selling covered calls when volatility is high. Hard to know how to know in the platform when the volatility is high. Michelina, thanks in advance. So Michelina, volatility is high typically after giant moves. So again, using a share screen here, going back here to Google, just because that's what's up on the screen. Let me just get rid of one thing on here. I'll go to Tesla and let me just pull that out. And let me pull out this and this just to clean up the chart so it's easier to read. Oops, one last trade. That was a tiny one today. So I threw these earnings lines in. Volatility, when you've gone on this rager right here, like from this earnings report and this buy signal, and it's gone on a rager like this, the volatility is going to be super high at this point. That's how you can tell. I mean, it's basically on rager moves. On the other hand, volatility had dropped some right in through here, because notice it traded sideways for a good, whatever that time period is, couple weeks, 2-3 weeks, right there, going from here to here, right there, July 24 to 4 of August. not much going on, just kind of going sideways. Then it dropped. So it's when it goes on these rager moves. And right here, it had like bottomed out. Volatility is often low when it's kind of hitting a bottom. You can also, you said using the tool, you might have meant using using share screen. You might have meant using like this screen. But a lot of times if you go in and you go build a long call, if that's what you're looking, or a covered call, if you're building a covered call and you're going to be selling it, a lot of times the volatility it'll set itself. It'll say based on an implied volatility of 119 right now on CleanSpark. On Goog, 30.9 is the implied volatility. It's going based off of a historical averages and everything else. I'm not the best at calculating that. I go based on whatever it tells me. Wish I was an expert on that, but I feel like that's a little more expert opinion. Tesla, oh, you can't see it, 51 implied volatility. So CleanSpark, it's going to be really high. Watch, MicroStrategy will be super high. It always is, especially with these crazy up and down moves. 69 higher than Tesla. Hope that helps. What other questions, guys? I was just going through the ones that were typed in here. Stuff might have been put into the chat. I got some direct messages. Sorry, guys. Mark, have at it if you would like to. Greenwood, have at it. It'll give me a chance to read some of these.
Well done, Gary. I'm sure that everyone else like me is giving you the thumbs up. A couple of points I would suggest. I'm not at your level. I think anyone that's watching this that hasn't dabbled could take something like CleanSpark and buy a contract or two. It's pennies in comparison to investing in general. The risk, should we say? But I think that doing that and then watching what happens to that position over the course of a week in comparison to the stock price is illuminating. Would you agree?
That what is illuminating? Sorry, Mark.
If you open up a CleanSpark for someone that's starting off, if they were to take out a CleanSpark contract and watch what happens to that contract value over the course of a week in comparison to the share price, it gives you an idea, because it's not, without being pessimistic, it's not all upside. And when you're buying something that's a year or 2 years out, there's going to be some red days.
Yes.
And when you're timesing everything by 100 for one contract, or you've got 10 or 20 or however many contracts you're running, a day can make a lot of difference. So it's a good grounding to get an idea, and also just to go through the mechanics of placing the trade. Because, for example, as you mentioned, Gary, you've got the bid and the ask on the call, and you touched on the fact that there's the midpoint. But obviously, we can use the limit orders. Just because something is quoted at sort of 220 and 230. We don't have to go at 225 in the midpoint. We can still go low, well, assuming it's a long call. So it's worth people familiarizing themselves.
All I'm doing is going back to that screen. So that, yeah, right here. Keep going, Mark. Sorry.
Yeah, so I think that would be highly worthwhile. The other thing that I think is, well, it should be second nature, is having an idea about what it is that people are doing. When I first came across options, which was very, very recently, I was of the understanding, oh, yeah, you buy something and hold it all the way to the end and blah, blah, blah. But of course, the reality is that they should be traded or can be traded in exactly the same way that you'd play or trade your proper stocks, shall we say. And just as a quick example, I missed selling my CleanSpark yesterday. Not that there's a ton of contracts, but there's a few. I did a trade not far off when James did his, and me missing that cost $1,000, which is not the end of the world. It's still very nicely in the green, But it's that kind of thing that gives you an idea of how you can play things. And going back to your chart setup, Gary, with Lilo and channels and all of the bits and pieces, it doesn't hurt to start off with a couple of cheap contracts and exit and enter and just see what effects that has. They can be, I think, a great tool. For me, I'm going to keep some of my contracts, or aim to keep some of them for slightly longer. But for sure, when I see the opportunity, I'm going to exit as many as I can, take the profit, get back in again when there's a dip.
And Mark, I hope you guys took notes on that. That was sage advice. I cut my teeth, so to speak, on stocks that were under $5. Because why? Because if I entered into a option trade on CleanSpark, and CleanSpark's trading at around $2 or $2.50, and I do a $2 contract and I get put 100 shares, $200 isn't going to make or break me. And I don't mean to say that it sounds bad. It might do that for you. If it does, then maybe these aren't for you, because you got to remember you're dealing with larger contracts. But it gave me the practice, Mark, just like, I mean, that is great advice he just gave you. I played with what happens when I sell a put. I was actually playing with margin. And what I realized, all of a sudden the margin kept getting recalculated because I sold the puts. I had to have at least $200, let's say in that example I just gave, worth of margin in there. But the underlyings that I was trading and all the other stuff in my account was going down at the same time. And all of a sudden it's like, you got to add more money, even on just $200. It's like, you got to add another. So I added like another $100. And then the next day, everything went down again. I had to add another $50. Before I realized it, it could become a giant money pit. But I'm glad I was playing with an option trade that was only $200, $2 times 100, not $20 times 100, or $200 a share times 100. So Mark, great advice. And also to follow up on what you said about trading them, it's something I've had a difficult time with myself. Take it from me, a guy that has a lot of experience with this. I've had difficulty with it because I've been a buy and hold investor my entire life. That's what I've done. I've always had a difficult time selling. I'll sell for a profit when the time is right, or if I needed the money or whatever else. But I've always had a difficult time. I've always just been a buy and hold seller, trader, not even a trader. I guess I'm a buy and hold investor because I'm not trading anything. I'm just buying. But if you do that with options, you can screw yourself over because they're not necessarily designed to buy and hold indefinitely. If we use the rhythm of the stock, the underlying stock, and you see the underlying stock looking like it's getting top heavy, just like you might sell some shares off there, why not sell your call and then buy it back? And to emphasize that point, Mark, that $61.28 Tesla option contract, or $6,128, at one point was worth over 90. I think it hit as high as 91 or 92.
I know. I sold mine.
Right, bastard. I could have sold mine for $3,000 and made 50% on it, and that would have been in like 2 weeks. Like, it was literally within 2 to 4 weeks, if I remember correctly. And I didn't. And I'm still holding that same one because by the time it had already reversed, now it wasn't the time to sell it. Now, if anything, IADSS was telling me to buy it back right now. But the next run it goes on, that thing's gone. Because I already know I can always go get it. There's always going to be somebody on the other end of the contract. And to Dave's point that asked why, I don't always know why. I don't know why somebody would want to sell you a 200 call right now. I don't know. Maybe they know something you don't know. Maybe they're the Uber bear. I mean, Lord knows we've got a few of those in our group, one of whom I muted. I flat out muted the guy because I couldn't take the negativity anymore. I'm like, dude, if you're that negative, you probably shouldn't be investing. And do not, Mark, you're laughing. I see you with the smile.
Because I can guess who it is.
And you muted him too. So just don't put any names out there. We're not in that business. That's not fair to those people.
Can I ask on the selling thing? So Clean Spark I buy and sell Clean Spark quite regularly. It dipped into like 420, 421 for only 5 minutes. So you're able to offload it that fast. The software allows that kind of quick movement.
No, you could put a
limit.
Well, yeah, you
a
can
limit
put a limit
order in. Yeah, you can put limits in on options, Dave, the same as stocks. So you could enter in a limit order at, let's say, again, if it was an option trade, and I don't even know what I'm blanking right now. I mean, I have some $2.50 one, $2.50 strike price, January 2025s. I'm trying to think of what they've even been trading at. I haven't been paying that much attention. And that's the other thing.
About 240, I think.
240. Okay.
Something like that.
You put a limit order in at $2.50. And if it hits that, bam, all of a sudden, $250 gets dropped into your account. The options contract is closed. If you're selling the call to close, that's also important, is the verbiage. Remember before, Dave, you said who would be buying that? And I'm like, no, dude, you bought it. Somebody else sold it.
I'm going to get it wrong for like weeks. Don't worry.
It's okay. But practice over and over again on the verbiage. Just say it to yourself. Like, go buy Mike Sincere's book, Mastering Options or something like that. Understanding Options. It's by Michael Sincere. I don't get anything off that book. It helped me immensely, and I've read it, and I'm like, it was a review for me, but I was like, wow, it helped me be able to teach this. I felt like, there it is. Thanks, Bill. So he's popping in and out. He's like, but in there, he actually suggested, because back in the day before computers, he wrote the book originally when you had to call in an order. He suggested practicing, like saying, hi, hi, Serge. Hi, Serge, this is Gary. Yes, I'd like to do an options trade, please. I'd like to buy, I'm looking at my screen right here. Am I still sharing my screen? Yes. I'd like to buy that 250 call option. I'd like to buy the January 17th, 2025 Tesla 250 call. And I'd like to put in an order at $70 even. So you see what I'm tying in what Mark said. It's between 70.10 and 70.35 right now, but I'm okay to put in a limit order. Sorry, I should have even thrown that word in. A limit order of $70 to buy that 250 call. The Tesla, January 17th, 2025, 250 call, put in a limit order to buy at $70. It won't execute at $70.10. It'll only execute at $70. You can do limit orders on options. And what Mark was talking about also, like using this example of 70.10 by 70.35 or a 25-cent spread on that 250 option. If you sold your call at 70.10 and the ask remains 70.35, then the midpoint will automatically be like 70.25, and you're already down $15 on that call that you sold. So you got to remember, the wider the spread, the more you could be down immediately upon execution. Does that make sense? Just like buying it. If you were buying and you bought at the ask of $70.35, but the bid remained $70.10, then all of a sudden the midpoint is $70.25 ish, and you are down $10 or $12.50 to be exact already on that right out of the gates. So you always want to try to shop for the best price. You'll hear James talk about that. Not as important in this example that we're talking about right here, because these are giant options, right? You're talking $7,010 versus $7,035. So on a percentage basis, that's like relatively negligible. But when you're talking about Clean Spark, and they're separated by maybe 50 cents, but you're talking about $2 for, a bid of $2.10 and a ask of $2.50, a 40-cent spread. That's a 20% spread. Almost close, like 15 to 20% spread that you could already be down by going one way or the other, selling into the bid or buying at the ask. So you always want to shop around and try to get a better deal. Will this available video? I'm just reading through. Some people threw their questions in the chat. Yes, it's all being recorded. Some people had to run. Think it would be good to touch on what to do when your option is threatened. That's a great, I wish I would have seen that a little earlier, Karstead. Yeah, I mean, you have options. Options. You have choices with your options. I can't stop saying that. You have choices with your options. You could, there's different things. Let's say it's a long call. You've bought the call and all of a sudden the price starts to go against you. It starts going down, right? So when you've bought the call, when you own the call and the price has gone down, what you can do is you could buy it, sell it at a loss and buy it back. If you think, oh man, this thing's never coming back, you could sell it at a loss, wait for the underlying to bottom out and then buy that call back. That's one option. You could just ride it out, right? You can ride it out and be like, look, I went into this knowing I could lose, in that case of the $250 call, I could lose $7,000 on this. You could ride it out in hopes that you have time for it to come back. If fundamentally you believe, and technically when you do your analysis, you believe that the underlying is going to start going back the other direction, you can ride it out. Conversely, if you've sold a covered call, you'll hear people all the time rolling their calls up or rolling them out. What is that? Or both. What does that mean? When you roll a call up, it means that like the $145 strike that I sold on Google, I could buy that back at a slight loss and immediately sell the 150 for the same date, November 17th. Let me do this so I'm not doing my fingers. Let me do let's do this for real. Let's be professional, Gary. You can do this, buddy. Cool. You're seeing this screen. Good. I don't know why the other, excuse me for just a second. And zoom. There we go. Wrong chart though. Right here. So let me, little secret. You see me hit the auto to adjust the screen. And then if I want, I can move this around and make it bigger or smaller. So I'm doing that because let's say that right in here, I'm wrong. And it starts going edging up at about this point. I could then turn around and buy back my November 17th 145 call, probably at a loss. If the price is up in this range, it'll be at a loss. And then turn around and sell the 150s, which is up here about where this dotted line is on the November 17th. I could do that, right? That's one option. I could buy that back at a loss and I could roll it out. So I could sell the 145 again. If I still think it's going to turn down and I want a juicy premium, I could do the 145. I probably wouldn't do that and do that out into November instead of, or what was already in November, do the Decembers instead of November, whatever that Friday is going to be. It's going to be about right there ish. Might even be the Friday before that. I'm just going off of thought. Or I could do both. Instead of keeping it at the 145, or instead of just going up to the 150 on the same strike expiration date, I could sell the 150 in December. So I could do the December 22 150s, or I could roll up even more. I could do the 160s if it's really on a tear. So there's options. Or the third thing I could do, so I could roll it up, I could roll it out, I could roll it up and out, or I could just let it execute. Take my chance, because I've already resigned myself that I'm willing to part with my Google shares, because I think that we're coming up here soon. I think we're gonna, the February, the all-time high is up here at 152. I just think that in this 145 to 150 range is where we're going to see somewhat of a reversal. I could be wrong. I mean, we none of us have a crystal ball. We all go based on all the different tools that we have. I saw layer 8 coming in here pretty hot and heavy. Thought we might bounce off of that. There's also a fib level just above that. I'm sorry, the all-time high is the next level. So those are things that you could do. Wish I had this when I first started. Thank you, Vicious Lee. Somebody that wants to do a session with me with a question. I'll have to get back to them. Mark, I got you. How do you know that a option is well priced or overpriced? Okay, the whole Black-Scholes model thing, if you want me to explain that, I'm not your guy. Let James confuse you with that. I mean, teach you on that. It's just profoundly confusing to me. I tend to look at that history on option strat. Who asked that question? Sailing Tortoise. If you're even still on here, if not, yep, I see you in the middle there. I tend to look at that historical. I tend to think about what the underlying is doing. I tend to look at whether it seems like it's in the right ball. Like, is the option going the complete opposite direction of the shares? Like, do they look like they're not working in sync with one another? I mean, those are things that I'm looking at. I'm looking at the historical volatility. I'm looking at the historical pricing. So that's how I determine whether it's well priced or overpriced. There is a whole mathematical model to it. It's pretty complicated. There are calculators that you can throw things into online that'll tell you fair prices. I will tell you this, and this is what I learned from James, is what was it? You want to buy time and sell volatility. Mike, do I got that right, guys? Mark, Bob, that sound about right? All right, I had it backwards. Sell time, buy volatility. Yeah, because basically you want that time decay to happen. You don't want it to happen to you. Sell time, buy in the money. Thank you, Karstedt. Sell time, buy in the money, because the time, that decay helps you. You know, as it's decaying, and if you've sold it and it's decaying, that means that option is becoming less and less valuable, which means that even if you had to buy it back for whatever reason, you could buy it back cheaper, or it'll expire out of the money. And in conversely, buying in the money, you don't want to buy time. Thank you, Karstedt. You're right. You don't want to buy time because you're buying all this time. You buy the call in the money. What does buying time mean? It means that if you had the option to buy one that's going back to that Tesla example, when the price was 260, do you want to buy a 300 call? It's going to be cheaper, but you're paying for $40 for time. Whereas, wouldn't you be better off buying the 260 or maybe even the 250, 240, 230, buying a little bit into the money? That'll be a higher delta on that, meaning the more the stock moves. That's another thing that you need to look at when you're determining pricing. I do, at least, is the delta. That the more the share price is going, the higher the delta means the higher the option price will go up with it. It sticks for me with buy low, sell high, sell calls high, buy calls low. Spot on. And that goes back to, am I still sharing the chart? No. Goes back to, well, here, I'll share. And I know I'm jumping in and out. I just feel like this is the best way to learn this stuff. I don't know where the heck Zoom keeps going, or not Zoom, Keynote's there. I don't know why it won't let me share it now all of a sudden. Escape that. Yeah, I was just going to show that one chart. Oh, here we go. Share this chart right here. Yeah. Buy a call when the price is low. Sell a put. Sell a call when the price has run, and or buy a put when you expect it to go back the other way. So basically, whatever IADSS is telling you to do, that's what you do with calls. And you do the opposite of it with puts. Hope that makes sense. So whatever IADSS is telling you to do, if it says buy a call. If it tells you to sell, sell a call. And then just do the opposite, dead opposite for the put, because the put is betting on it to go down. So you're going to have to flip it for the puts. That's the easiest, I think the easiest way. I could be wrong. James talked about, oh no. How do you keep track of all my option trades? I'm a guy that loves spreadsheets. I got problems. My wife thinks I have problems. She wants me to like go see somebody for it pretty much. Some of the guys on here have seen my spreadsheets. Although I got to admit, a couple of them have some really damn good spreadsheets too. I keep track of it like I would keep track of a ledger. So I do QuickBooks for I own a bike shop, also a bicycle shop. And I taught myself accounting. I never knew how to do it. So I taught myself QuickBooks. I hired 3 different accountants and they all sucked. They don't know the bike business. I do. So I just taught myself that. So you do it like credits and debits. If you sell a call, you know, you've sold it for, you know, in the case of that Google one that I did, I sold it for sold the 145s for $2.30. So that's $230, right? So that is a minus 230 into my account, because that's the way that it works, because I didn't have to pay that money out. I got that money in return. And then when I turn around and buy that call back, like in the example that I did before, I sold it for 130. So that's $130 into mine. I bought it back for 19 cents. So that was $19 that went back out. So I had 130 come in, 19 go back out. That trade was closed. And I literally just abbreviate the call. So that would be an S for sell, one contract, 10, 20, 23, October 20th, 2023, 145 call at $1.30. I just abbreviate that. There's tickers for you can look those up. There's tickers for them where they just compress it into just a letter string. But that's how I keep track of all my trades. Man Z. Mark, cheers, mate. Thanks for jumping on. Thanks for staying up late, man. You guys are heroes, freaking heroes. All right, brother. And I'll chat at you tomorrow, Mark. How do we pick other low price stocks to start with? Mike C. Mike, that's that's where the fundamental analysis comes in. Fundamental tells you what to buy, right? What to buy or sell. But if you're going to talk to a lot of us on here, it's going to be like miners. They're Bitcoin miners, because they're all trading pretty low. I also work with a network marketing company, a multi-level marketing company. Their share price is right around $7 right now. It's called LifeVantage, LFVN. I'm not trying to promote that. I'm not saying that is you should buy it or not buy it. You should sell it or not sell it. I am not telling you any of the above. I'm telling you it's listed on NASDAQ and it's a $7 stock. Research the stock. See what you like about it, don't like about it. Maybe you don't like the industry it's in. It's in multi-level marketing. And I can tell you, Wall Street does not know how to value multi-level marketing companies. They don't. Despite the fact that we rang the bell a month ago at NASDAQ up in New York, 2 months ago up in New York. So, but that you just got to go start looking through and digging through some of these stocks that are like, let's say under $10 and find ones that look ripe for the pickings. That's how you would start. You don't wait a year on your synthetic longs or long calls for tax purposes. I don't. I'm doing a lot of it in an IRA but I do some in a taxable account. And if you can make 50% on an option trade and you can do that in a matter of a couple of weeks, take the money and run, pay the tax, pay the tax, man, and be happy that you got to give up, whatever, 40%, 30 or 40% of it and just move on. I can't give you tax advice, but that's me. Bill, gotta go. Profit zone. Yeah, a little profit zone thing on the chart. It really helps. So cool. Do you usually buy more calls than puts or vice versa? This is my first time. Really a beginner. Forrest Muldoon. I buy more calls. Market goes up 80% of the time. I may be that fish that swims in the other direction. If everything I read in mainstream media, this is a joke, by the way, I'm just prefacing it. If everything I read in mainstream media here in the United States is true, I can assure you I'm not part of the majority. I can assure you of that. And despite the fact I go against the grain in many, many aspects of life, I am not going to try to go against the grain in the markets. If I know something is going down, like I just know. I knew some insider information on something. Shouldn't even say this, but I just knew some stuff. Not from any of the executives of a company or anything else. I just know the internals of a specific company. Wait for Kramer to say bye. Karstead, I love you, bro. That's it right there. Karstead sells buy. That's when you buy your put. You do not buy the call. You buy the put then. But no, if I knew something was going down, then I would buy a put. I've bought very few in my lifetime, like probably less than 5. Calls, lots, hundreds. Yeah. I'm always betting on things to go up.
Can I add a comment, Gary?
Yes, sir, please.
I mean, for me, and I'm relatively new to options, and I'm one of Gary's students as well. But let me offer this. I don't think I would touch a put at this point. And a lot of it has to do with cash secured or having margin and those types of things. But if I buy leaps and sell calls, right now I've been 100% successful, and I'm using option strat. And on a day like today, when things are going down and you have conviction to hold an asset like Tesla, and you sold calls last week, you can buy them back, and I'm going to make 73% in like 3 days. So I think I would pay attention to the when an asset spikes, sell the call. When an asset dips, buy the leap, buy a longer call. But you can use option strat as a paper trader for a little bit, dabbling, or mock trades that you see that are flying through on Discord. For me, I did that for about a day. I don't have the patience to paper trade something. So I started with CleanSpark, and then I went right to Tesla because I mapped out on an Excel spreadsheet the spreads every week for the last 2 years. I was like, okay, I know that I need to be 10, 15, 18 points. So I bought calls that were beyond that. 100% of them were in the money. Now, we all know 9 out of 10 times or whatever, it's going to go one way. 1 out of 10, it might go the other way, something like that. So I thought to myself, if 90% of the time they expire worthless, that's a winning strategy, because only 10% of the time would it be exercised, or would you lose out on that. So just going back to the fundamentals of it and using option strat and Gary's training, a lot of solid stuff. I would tell you stick to the calls portion as a beginner, long before you start jumping into puts. Now that's just my opinion, but I wanted to share that because I've been experiencing it and trying it, and been doing it with MicroStrategy and Tesla and CleanSpark, Bitfarm, and a few others. And assets that are going down, those are the red that someone mentioned a little bit ago. Mark, I think it was. When things are trending down and you sell a call, you're going to see a lot of red at times, or when you buy a leap, you're going to see a lot of red. But with Tesla right now, it's been very easy for me to play. When it spikes, sell. When it dips, buy.
Awesome advice. Thank you, Bob.
All right. Thank you, guys. I appreciate it.
Yeah, absolutely, Forrest.
Yeah.
And Bob, thank you. I appreciate the kind words, dude. And I showed Bob that option strat. He was like, holy crap. It literally was firing me questions for the next 48 hours straight. He doesn't look. That's the other thing, guys. How serious are you about this? Like, you almost treat it like it's your new job. You almost treat it like it's life and death, as crazy as it sounds. And I know for some of you that may not be what you want to hear, but we treat it like it is. We're serious. We are dead serious about this for our financial future, our family's financial future. One of the guys I worked with, he's ill and he's worried about his wife. It's gut wrenching. Like I was in tears working with him, and it's a tremendous amount of pressure. And I cannot give you financial advice. You can ask Bob or anybody else that I've worked with. You run your ideas by me, and I'll just say technically whether it makes sense or not according to a chart or whatever else, but you ultimately have to be the one that decides the number and pull the trigger. I'll help you on your verbiage, Dave. I'll make sure that you say buy or sell so you're doing the right thing. Bob said also review your account for those that you own 100 shares. Yeah, I mean, like doing a covered call, make sure you have 100 shares in there to do that. And if you sell again, if you were to sell the put, then you're going to get stuck those 100 shares at whatever it's for. So I think that's sage advice. I mean, I did some synthetic longs, and you can tell I'm not even that jazzed on them. I'd rather buy the call. I don't want to be liable for the put. I don't want to be liable to be put those shares if I was wrong. If I'm right, you can definitely juice a bigger return on synthetic longs. But if you're wrong, you could also lose more money and be stuck with shares that you may not have wanted in the first place, or at least not at a price that you wanted them. Are you selling it out of the money? Whoa, that one just jumped up. Mark, are you selling it out of the money call against your originally purchased call? I don't do a lot of that. Whatever my originally purchased call is, I'll just sell that one outright. I'm selling out of the money calls just above when I think a price, like Bob said, when it's spiked and you get that sell signal or you see the trend turning over, I will sell a call out of the money against shares that I own. But if I own a call, that's the time to sell the call itself. Just go ahead and get out of the call. How much time is required to successfully trade options? Weekly estimate, Mike? I mean, I'm spending all the time right now because I have it, and I'm teaching it, a lot throughout the day. Bob, what do you think? At least
an hour a day,
5 to 10. Yeah, so I was gonna say 5 being an hour a day, because you can't just go into it. And it says that in Michael Sincere's book, that understanding options. Don't just buy a call and expect to hold it for, a year and a half to expiration. Like, you have to monitor these things at least once a day. Just check in, see what's going on, make sure everything's still going the way you thought, or do you need to make a change? Do you need to roll it up? Do you need to roll it out? Do you need to sell it and buy it back lower? Blah, 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 blah.
you can set alerts though as well. So, think about it from that perspective, because if I don't plan it, I'm going to go fishing tomorrow. So I can just set alerts for prices. If my phone starts blowing up, maybe I stop in between casts and take care of a little business. But to be honest with you, I mean, literally my goal, I'm retired. My goal is to get this down to an hour a day. Now, right now I'm an enthusiastic beginner, if you will. So I'm looking at stuff and, mapping stuff out and things like that. But, the end game for me is an hour a day, start in the morning, that first hour of the trading day. So maybe an hour and a half, a little bit before and a little bit during, and then wait for the alerts.
Yeah, I think that's great. And I just saw your answer, Bob. I'm sorry, I didn't see that where it says, don't start with too much energy. It's easy to do. Hour a day, wait for IADSS. And Karstead said, you'll get to the point where you don't need to spend hours any day, but it takes work to get there. It's like anything else. I equated a lot to what I have chosen as my career path for the last now almost 13 years, network marketing. You hear all these people come in with all these dreams and ambitions of making tons and tons of money. And you ask them, how much time are you willing to put into this? And they're like, all the time in the world, I'll travel anywhere. I want to build a team all over the world. I want to do this. I want to do that. And a month later, they're already out of the business and they've already quit. And they say it doesn't work. It works. I'm 13 years in. I've built a team of over 4,500 consultants and 25,000 customers in 18 countries all over the world. Don't tell me it doesn't work. But how many hours did I work at the beginning? All of them. I had no free time. None. Zilch. I quit bike racing. I would go work my day job. I'd build my bike shop business, do the books in the evening, and whatever other time I had, I was doing meetings to build my LifeVantage business, my network marketing business. I'm not here to promote that tonight, but to build my business. Was it worth it? Yeah. How much time do I put in now? Bob, about an hour a day. I probably don't even put that in. I probably put a half an hour a day. I put in about 3 to 5 hours a week into my network marketing business. The one that I put all the hours in 13 years ago, 13 years later, I put in virtually no time anymore. I don't need to. I've got leaders upon leaders upon leaders in my organization. Using Bob as an example, since he's a huge fisherman, again, I don't want to go catch anybody a fish. I want to teach people how to fish. That's why I wanted to do this meeting today more so than anything. And I asked James for permission. I don't want to step on his toes, but this is where I excel. This is what I've been doing. I've been teaching people how to build a business for the last 13 years. This is very similar. Investing is very similar. At the beginning, it's overwhelming. Bite it off little bits at a time. Figure out your rhythm. That's why I put that post in the IADSS discourse today. My goals are not your goals. My trading style is not your style. My time frame is not your time frame. I do a lot of things very much like James because, like him, I lost my mom and dad to cancer. I don't know that I've got tomorrow. None of us do. And I say, Bob, that all I do is I do this all day long. I was on my trainer in the middle of the day today for an hour and a half. I got tired of watching the freaking market going down. I'd already done everything I could do to mitigate it. And I'm like, I'm going to go get on the trainer and go ride the trainer. What did I do? I was watching videos that I was learning. But anyway, guys, it's super late. It's 10 o'clock. What'd we go for? 3 hours. I promised an hour, hour and a half, and went for 3. I hope I over delivered and under promised.
Let's go for 4.
No, we're going to pull up short of 4. Those of you, I'll put, again, it's,
That's no way I can do 4.
oops.
It's 3. It's like, what is it? Yeah, 3 a.m.
Yeah, no, you guys are, Dave, you outlasted Mark. That's all I'm gonna say. You take the cake, mate. Go get some sleep, bro. I threw it in there again in case anybody wants to book anything. That way it's in there. It'll be there on the in the meeting chat. That's my Calendly link. Bob, thank you for saying that I didn't want to say who were my students and who weren't, but I saw a few of them on here today, including Bob. I've worked with him pretty extensively and we've had a lot of fun, guys. I literally make it so that it just kind of pays for my time that I'm putting in.
I'm Bob and I'm a student.
Everyone
have a good night.
Have a great night, everybody. Thank you so much. Have a great evening.
Yeah, thank you very much.
All right. Cheers, guys.
Thank you.